Right now, speaking of my dad right now, it's like, why isn't the show on? Can't get the show. It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance Live. Happy Black Friday. This is what we are watching this morning. Well, Black Friday is in full swing. Retailers are keeping fingers crossed that shoppers are going to stay resilient after warnings of a holiday season slowdown. Now, it is still expected to be one of the busiest shopping days of the year, especially for online buyers, and employees are taking the opportunity to take a stand. Workers at Amazon warehouses across the globe are striking in protest of the e-commerce giant's working practices.
Plus, investors are still betting Fed hikes are all but over. Treasury yields nudging higher this morning and equities continuing their weeks-long upward momentum. Investors looking to capitalize have poured $40 billion into U.S. stocks this year since October, according to Bank of America. The Fed's preferred inflation gauge out next week that could be consequential to this rally.
And Nvidia share is taking a hit this morning on a Reuters report that one of its most powerful China chips will be delayed. The chip maker designed the semiconductor specifically to skirt U.S. restrictions, and the setback could complicate efforts to keep its market share within the country.
Well, put down the fork and pick up that credit card. It's time to shop. The National Retail Federation projecting a record number of shoppers to hit stores both online and in person this Thanksgiving weekend. And today, Black Friday is expected to be the busiest. Still, numerous retailers are bracing for a more challenging holiday season as the resilient shopper begins to weaken. Will the deals be enough to draw folks in? Let's get on over to our man in the field, Yahoo Finance executive editor Brian Sazi, who's over at Roosevelt Field Mall. Wait a minute, that shot looks so good. I'm convinced you're just in your kitchen, Brian. That this is a okay. We're gonna get Brian's audio figured out real quick. All right, we're gonna go back to Brian in a hot second here, and we're gonna get his audio figured out. But a lot to really kind of look forward to, especially as many of these deals, the doorbuster deals at least, because Black Friday is looked at that day for those doorbusters, have already begun. Many of them perhaps even at 5 a.m. But as we think about how much of that is actually pulled forward and shifted into earlier points of the season too, and the amount of that is now permeated across not just brick and mortar and in-store, but also spread across digital. You've gotten a lot of those push notifications, even last night, a lot of shoppers perhaps. So it's a larger question of where some of that foot traffic versus where the online traffic is starting to peter out at this moment. But consumers are looking for deals right now.
Consumers are looking for deals. And when you take a look at some of the recent data that we've gotten out, really specifically from Adobe, you mentioned the fact that some of these deals have been pulled forward here. Well, that is exactly reflected within these numbers. Taking a look at October, prices for apparel was down about 9%, was 9% lower at the end of October than it was at the beginning of October. I'm putting this in perspective here. Compared to 2021 and 2022, it's just about 2 to 5% lower in prices. So we certainly are seeing further discounting here, at least at this point. You take into account how many shoppers maybe have already spent their money here this holiday season. Despite all that, though, still a number of Americans are planning to still hit the stores or maybe order online this weekend. National Retail Federation estimating 182 million people will be shopping in-store and online over the next several days through Cyber Monday, 15.7 million more people than last year. So despite the fact that we have seen so much hype and really retailers follow through and really be forced to offer better promotions, we are seeing Americans still willing to spend and planning to spend throughout this holiday weekend.
I mean, it's not even Black Friday specific anymore. Yeah. It is Black Friday in July. You got Black Friday in October with Prime Day and the added on deals that they've done there. And then if you're overseas and you just love Singles Day, then you got that in the Asia Pacific region with some of the retailers there online really being able to push that forward. JD.com, Alibaba, two of the biggest names there. But then as you think about the actuality of Black Friday and how that typically is seen as the retail kickoff to the shopping or the holiday shopping season, even some of the biggest retail CEOs are admitting that Black Friday is more of a concept. Here's what Walmart CFO John David Rainey had to say to us.
Black Friday really is no longer a day, it's more of a concept. We at Walmart started our events on November 8th with deals for our customers. And even if you look at the period of time between Thanksgiving and Christmas, we have an extra day this year. That always distorts comps year over years, and so you tend to look at these things daily and look at the trends first thing in the morning and try to observe what's happening in the business. So we'll be watching closely over the holiday shopping period.
And so that's coming from not just the largest grocery retailer in the world, but of course a business that also does well in other categories because they are that superstore that tries to make sure that they can get people into other aisles, discount appropriately. And so that's exactly where we're going to be continuing to watch as well, where that discounting and promotions take place. Here we got Brian Sozzi back. We're going to go back to what I believe is his kitchen, but is probably the mall because he's been at the mall since this morning. Brian, great shot there. What have you been seeing?
Brad, you better be nice, because I'm going to go down to Santa on the other end. I'm going to ask if you and Shauna Smith have been good global anchors, and if you haven't, Santa's not bringing you any presents. Nonetheless, we've been at Roosevelt Field Mall on Long Island all morning long since the mall opened a little before 6 a.m. Crowds are starting to build here, and really one of the surprises for me is that there are actual human beings in this mall, and that means they're probably not online shopping. So people are out there hunting for big deals. I think they're going to be disappointed by what they find depending on where they go. I went to Abercrombie & Fitch. Of course, that chain has been on absolute fire, only offering 25% off. There's a Coach store next to me right now. Not a lot of discounts in that store as well. A lot of retailers holding price or holding firm on how much they're trying to just discount on Black Friday. But having said that, the discounts are there. You have Gap up to 50% off the entire store. I went into that Gap store. I was seeing a lot of inventory, which really speaks to, I think, the challenges with Gap. But also keep in mind, it has been warm in a large part of the country, meaning not a lot of people are out there buying jackets, sweaters, et cetera, and so they absolutely need it. So that is observation number one. And then number two, people are in fact buying things. You can see a lot of shoppers in here leaving with bags, a lot of teen shoppers. It's an Abercrombie & Fitch and a Hollister look like some early holiday season winners. Nike too as well. Foot Locker seeing some early traffic. The Apple store, of course, very crowded. But like you were talking about earlier on, there's this sense of caution when you talk to shoppers about how much they're going to spend this holiday season. And we did get a first round of data earlier this morning from Salesforce. That is their online sales on Thanksgiving, according to their data, only up 1% year over year. So this could be a late holiday shopping season. Consumers looking for those best deals because inflation is still high. Student loans are back in vogue since early October. That is money that is not going to go into the registers, a lot of these retailers. So again, there is a cloud of uncertainty at the mall, despite people out there buying stuff. I will add this too, and maybe this is open for a discussion. You can note the increased security presence at the mall. We've been talking all year long, our very own Brooke DePalma, our retail reporter, talking about more rising retail crimes throughout the country. Some of it has been very egregious. In this mall, Roosevelt Field, a couple of weeks ago, in fact, there was a smash and grab at the Macy's downstairs. Somebody walked into the store, smashed a case, and left with reportedly $30,000 of jewelry. So this stuff is real. You can see that increased security presence here. Have seen police on site. So interesting dynamics, but nonetheless, early takeaways, not a bad start to the holiday shopping season.
Yes, as we've been talking for so long about the rise in retail theft and how big of an issue that is for retailers really across the board. I want to go back to something that you did say, though, the fact that some of these discounts maybe aren't as great as some of the shoppers were hoping they would be. In your conversations that you have had, I know you've been talking to a number of retail CEOs over the last several weeks, but even in your discussions early this morning, are you getting the sense that maybe we'll see better promotions the closer we actually get to the holidays?
We are seeing promotions, Sean. I want to clear that up. They are offering discounts in here. Some chains aggressively, like I just mentioned, Gap. But let's keep in mind where prices have come for retailers. I went into the Abercrombie & Fitch store about an hour ago. I was looking for a jacket. That jacket, $260. The entire store was 25% off. So you get a discount, but let's keep in mind, inflation is still very much riddled throughout this mall and all these stores you go to. You go into a Gap, maybe you see an $80 sweater. Sure, it's 50% off, but for a lot of households, these purchases are priced more versus last year because of various components to make the goods are still going up. Of course, retail wages are still on the rise. So yes, you may get that discount, but it's still, in some cases, going to bust your wallet. Now, I ordered something this morning from Best Buy. I only got $50 off from what I ordered. It wasn't a great deal. Of course, there's the typical doorbusters on various electronic items, but nothing that absolutely, I would say, blows my mind in terms of discounts.
Saz, the big question, though, is Abercrombie, are they discounting your new Fierce cologne? Are you going to go get round 2 on the bottle?
There's typically no discounts on Fierce cologne, but I didn't look for Fierce cologne because I already have a whole bottle of it, so I don't need it anymore. So I'm going to go try, I think, maybe to pick up some gifts for you, providing we're good global anchors this year. Verdict's out yet on that one.
All right, well, we can send you over maybe a few things that we have on our list this year.
We've been good, Zazie.
Yeah, we've been very good. All right,
well, Brad, you're getting this bottle of Fierce cologne. Sean, I'll find you a gift card to maybe, I don't know. What, Ann Taylor? Is that still cool? I don't know. I'm not really that cool anymore. Ann Taylor's kind of cool.
I'm not picky. I'll take anything, Zaz. All right, Zaz. Great stuff. We'll check in with you in a bit. Thanks so much. Well, NVIDIA's earning beats aren't wowing the street the way that they once were. Now, despite what was considered a very solid fiscal third quarter report and outlook this week, shares fell in the aftermath. Concern over China was a big part of the reason. Now, shares are down again today, and it's all part of the same story. Yahoo Finance's Dan Howley is here with the details. And Dan, we're getting reports that maybe we could see a delay in terms of the chips that would be approved or okay here for China going forward from NVIDIA.
That's right, Shauna. This is coming from Reuters. They're saying that the H20 chip that NVIDIA was putting together as kind of a solution to the export blocks that the U.S. has put in place on high-end chips going to China would be delayed because of issues with server manufacturers getting that chip to kind of slot in. So that could be a potential issue and not something that was discussed during the recent earnings call. Now, just to go back to that call, NVIDIA essentially said, look, we're looking at this China issue where the U.S. put these export blocks into place. They have to get licenses for certain chips. They have to get sign off for others, and then others that are even lower power than those can just kind of go through. But according to Colette Kress, the CFO, the market in China, as well as other countries that are facing this export block, make up about 25 to 20% of NVIDIA's overall data center revenue in recent quarters. So if they don't get the chips that they're working on to kind of work around those blocks into place, then that could be a long-term problem for NVIDIA. Here's the thing, though. When they did have this earnings call, they didn't say how long they would be impacted. So, you can kind of take this as part of that story. As you said, yes, it seemingly is a new development, but it could just be a part of what they were discussing at that point without letting the idea that this chip, this H20, is having issues. So, overall, yes, shares of NVIDIA are down this morning, but in general, Wall Street analysts that I spoke to last week after the earnings were still very upbeat about NVIDIA. They were saying that, look, $1 billion potentially off data center revenue, sure, but that would have still put them, if they were able to meet that, ahead of expectations that Wall Street was looking for the next quarter, or the current quarter that we're in. So NVIDIA seemingly continuing to be the juggernaut that it is in the AI space, and not slowing down. And during the conversations that I've been having with folks, they say it's the hyperscalers, the Microsofts, the Googles, yes, them, but also regional cloud service providers, governments, governmental institutions. Everybody is trying to get their hands on NVIDIA chips, and so that's a very big deal. Yes, it's an issue that China, one of the largest markets in the world, might be a problem for them right now. you got to imagine that NVIDIA is going to get a workaround going properly, and that they'll be able to continue to sell into that market. But there are rivals like Huawei waiting in the wings that are hoping to snatch up some of that market share that NVIDIA has there. So they're going to have to work quickly.
This is a company that had just reported earnings, Dan. So does this dramatically change or materially change at all what they had talked about in their earnings results and on the call, and the demand and how they would be able to meet that internationally versus now with this impacting the H20, potentially even the L2 and L20 chips as well?
I don't think so, right? Because, Kress had basically said, look, this is not something we don't have a timeline for this yet. We don't know how much this is going to be impacting us, the bans at that point, not the issue with the chips that Reuters is reporting now. But I think, if 6 to 1, half dozen the other at this point, right? They knew that there were going to be issues with China moving forward. This is just kind of another hiccup, but we didn't know when those issues would be resolved. So, I think the going thinking here would just remain the same, right? That they're going to continue to be able to sell elsewhere in the world. They're going to continue to be the juggernaut that they are. China is kind of almost at this point a black box until they can get a better understanding of how they can sell into the country, as well as when these chips will eventually be available. But not news that investors want to hear necessarily. But I think it's still status quo as far as since the earnings report came out.
All right, Dan, stay with us. Let's talk about Roomba, or at least the company that manufactures it. Shares in iRobot, they're rocketing this morning. I want to report that the European Commission will greenlight Amazon's $1.4 billion bid for the company. Reuters saying the deal for the vacuum maker is on track for unconditional EU approval. Yahoo Finance's Dan Howley here with us on this story. Dan, what do we know? What significance now does this carry? I mean, for many people, they think iRobot, they think Roomba. Is this such a huge deal? And if so, why?
I think, just the general crackdown that we've seen on big tech in recent months and years, it really is what we're seeing here. Obviously, Amazon facing pressure globally because of their practices and what some governments or governmental organizations deem as monopolistic or violating antitrust law. This is part and parcel of that discussion, whether or not they should be able to purchase a large company like iRobot. I think, when it comes to this news out of the EU, or this report out of the EU that they're getting unconditional approval, it's a win for Amazon, right? They're going to be able to capture a lot more data from users because of these vacuums. It's a vacuum cleaner maker, yes, as well as some other products, but they're the discs that cats ride on around your home while they vacuum, and you just don't want to have to deal with that. So, it's seemingly not that big of a deal of a product when you kind of think of it that way, but it's that data that would give Amazon a leg up. And, the Alexa ecosystem that they offer, this would allow them to integrate that into that portfolio and potentially provide Amazon with a better look into consumers' homes, barring any kind of setbacks from consumers saying, look, we don't want to provide that kind of access. If they can do that, then they can get a better understanding of what the average consumer's household is like, and then potentially produce products that fit into that somehow. So it's really about the data here. That's vacuums are vacuums. The data is much more important for the EU to provide this kind of unconditional approval, according to reports. That goes along with the UK, as well as the US, which is still looking at it, the FTC, although this really wasn't brought up as part of the FTC's lawsuit against Amazon. So we're still wondering what's going on there as far as approval goes. But, if the EU is approving this, which has cracked down significantly more on big tech than the US, then you have to wonder if the U.S. then is going to approve this as well. And then, like I said, it comes down to the data. If Amazon can actually go ahead and secure this deal, it's going to provide them with boatloads more data about consumers' homes and then fit that into the Alexa ecosystem.
Well, Dan, what do you think this also tells us just about future M&A, right? I know we still don't know what's going to happen with the FTC here in the U.S., but if they, in theory, do get approval for iRobot, what do you then think that tells us just about some of the other acquisitions that could be lining up for Amazon down the road?
Yeah, I think when it comes to something like iRobot, it doesn't feel as though this is such a massive potential market, right? I mean, sure, people want robot vacuums. There are other companies out there that produce robot vacuums. iRobot happens to be, one of the largest names. Roomba is, synonymous with little robots in our house. And so I think that's really something that people are focusing on here when it comes to this announcement. But I don't think it necessarily rises to the kind of level as something like we had seen with Microsoft and Activision Blizzard, right? Like that is such a massive deal and a massive company in that particular space, in such an important space as far as the overall revenue globally, that I think, that obviously deserved that kind of scrutiny. Now, when it comes to Roomba and iRobot, to me, it doesn't seem as though it's as important or as large of a market. But as I said, this comes down to the data. So I think it really comes down to what regulators see as far as the importance of this particular kind of data. And it seems as though, at least in the EU, according to this report, they're okay with it.
All right, Dan Halley, thanks so much for breaking that down for us. We need to get over to Jared Blickery, who's standing by for the opening bell, which you just had about a minute ago. Jared, what are you seeing in terms of the early movement in today's action?
Well, we are seeing a little bit of movement, and you might expect on the Friday, Black Friday, after Thanksgiving, a little bit of quietness, and that's what we're seeing, actually. This is the four-day price action, captures what has happened this week. Markets up 1%. This is a Dow. We can also check on the Nasdaq, which is underperforming a little bit, and then the S&P 500, see that's up about 87 basis points, so not quite 1% just yet, but I think investors will take that. Just real quick, wanted to go over a chart that I put up earlier in the week before the holiday. This is what tends to happen on each of these individual days, plus the entire week in pink here. Friday is this orange line here. So in the S&P 500, we see meager gains, I guess you could call them, compared to Wednesday, which is a little bit of a better day. And in fact, Wednesday was a pretty nice day coming into the holiday. Here we have the Nasdaq and the Russell 2000, all three of these up, expected to be a little bit less than we got on Wednesday. But going back to the market, let's see what's rolling here. We have an early close today in stocks and also in bonds. So we'll have to see what comes of that. But I think a lot of traders just kind of taking the day off, and I couldn't blame them for that. Here's a NASDAQ 100, and you can see a lot more red than green here. Apple down about 0.4%, but not really seeing too much dark red, too much dark green. I was looking at the Yahoo trending tickers list. Not a whole lot of action there, except for in some of the indices itself, which kind of tells you what the thinking is in terms of the popular tickers, people just interested in the general market. Energy is the number one large cap sector of the day. That's up 0.4%, followed by healthcare, materials, staples, industrials, and finance. All of those outperforming. Consumer discretionary also in the green there. But real estate, tech, and utilities, those three are in the green for right now. Let's take a look at some of our leaders. Looks like Bitcoin. Bitcoin is up 1%. Take a quick look at that in a second. Then we have gambling, IPOs, small oil players, retail. Those are the outperformers. To the downside, meme stocks, that ETF, Korean stocks, solar, looks like, what is that, cannabis as well. Those are down about 1% or more. And just focusing on the crypto market for a couple seconds here, crypto never sleeps, Bitcoin never sleeps, so we can check on what happened over the prior couple days here. Really just camping out by these recent highs, 37,600. You take a look at the year-to-date price action. It has been a steady series of higher highs and higher lows. That is the definition of an uptrend. So on an intermediate basis and almost going on a longer-term basis, we are still seeing Bitcoin in an uptrend. You take a look at the last 5 years, everything's relative. You can still see nowhere near these peaks we had a couple of years ago, but heading in the right direction, guys.
All right, Jared, certainly. Well, hopefully that direction continues here throughout the end of the year and then, of course, into 2024. Jared, thank you. We want to get to our big international story that's on our radar this morning. Israel and Hamas have begun a 4-day ceasefire. It will allow humanitarian aid to reach Gaza and the release of dozens of hostages. Joining us now, Yahoo Finance's Rick Newman. And Rick, we're just getting reports here within the last several minutes that the first group of hostages have been released.
Right. So they are not in Israel yet. It sounds as if this is two groups of hostages, actually. 12 or 13 Thai nationals who Hamas grabbed when they went into Israel on October 7th, and then maybe around 10 of the women and children that have been the focus of these hostage negotiations in this ceasefire. So the way this is supposed to work is Israel says there will be a ceasefire for every day that Hamas releases some of these hostages, and the expectation is that this will take place. This first exchange, anyway, will take place over 4 days, and there are about 50 women and children out of more than 200 hostages that Hamas took on October 7th that they will release during the next 4 days. So this is just surrounded by unimaginable tension for the families of these people. And it's not at all certain we're even going to get through to the 4th day and get 50 hostages out. But I guess if these reports are accurate, some of the hostages have been released. It's an encouraging start.
Yeah, Rick, certainly as we've had weeks now of calls for a humanitarian, ceasefire, and now the beginning of the release of 25 hostages that you mentioned here. What is expected to come next? What is, at this point, between kind of the two entities, the two countries, and then additionally, what are we hearing from some of the U.S. representatives to the extent that they're continuing to have an eye on this?
Well, let's say we, fingers crossed, we can actually get through 4 days of hostage releases. I don't think that's a given at all. But then let's say we get through this and we do get the release of 50 hostages. Then the question is, what next? There will still be more than 150 hostages. We may get all the women and children out, but what about the rest of the hostages? And then Israel has said they're basically pausing this war. And as you pointed out, Brad, importantly, the pause does allow some humanitarian aid, food and fuel and desperately needed stuff like that to go into Gaza. But then what happens after day 4? Does the war resume? What happens to the other 150 hostages? I don't think people get their hopes up about peace breaking out anytime soon, but is it possible that if we can get through 4 days, perhaps a little bit of trust gets built, maybe trust in the negotiators, which include Americans, but also Qataris? Does that allow for some further exchange of hostages, or do we just go back to war? So many unknowns here, but at least a little bit of encouraging news today.
Yeah. All right, Rick, we're going to continue to monitor this, as we know you will as well. At least a perhaps moment of relief from the firing and all of what has played out in the region. We're going to continue to track this. Thanks so much, Rick, for bringing this to our attention. Well, Treasury saw a decline this morning as trading is set to resume post-Thanksgiving Day, with investors keeping an eye on what the Federal Reserve may do going into 2024. This comes along with the side of European bond markets that remained open on Thursday, and it's causing some concerns about what the central banks in Europe will do to fight inflationary pressures. All right, so a lot to break down here, especially as we're taking a look at some of the moves in the U.S. Treasury yields here. But most notably, it's also where this has prompted more of a move into some of the other investment plays and portfolio plays, and particularly as Bank of America has been talking about, into some of those other stocks as well. Investors putting $40 billion in some of the largest inflows that we've seen since February 2022, Bank of America putting out this morning.
Yeah, certainly taking a look at some of these numbers here, $40 billion to cash, $16.5 billion to stocks, $4 billion to bonds, 700,000 here to gold. We talk about the fact that we have seen this renewed optimism here heading into the end of the year. We saw it, I think, going back really most recently, I should say, to the latest inflation print that we got out just a week and a half ago, the CPI number showing that inflation cooled during the month of October, really renewing some hopes that the Fed is actually done raising rates. And then, of course, that also moved up the timeline in terms of what traders were betting on when the Fed would eventually begin to cut rates. Right now, that seems to be, they are pricing in as early as May. Whether or not that holds, obviously the data is going to dictate that from the Fed. In terms of what we could expect at this next Fed meeting that's happening in just about 2.5 weeks from now, 99.5% chance, that is what traders are betting on right now, that the Fed holds rates where they currently are. So looking ahead then to 2024, of course, the conversation will be around whether or not that strategy will continue. And then, of course, if the Fed sees enough in terms of its fight against inflation to tame inflation that they feel comfortable then cutting rates. And we know that that obviously has had a massive impact on the moves that we've seen play out in the Treasury markets over the last several months. So, of course, the movement in the yield going forward will very much in part be dictated by what we're hearing here from the Fed.
Absolutely.
All right, well, stocks searching for direction just after the market opened on this shortened trading day with just 6 days left in November. Is November on track to be the best trading month in 3 years for global stocks? The MSCI All Country World Index is up just about 8.6% this month as traders are betting that the Fed is done raising rates. As stocks have surged this month, strategists are making major bullish calls for 2024 despite some recession concerns. We want to bring in our next guest. We want to bring in Michael Green. He's the chief strategist at Simplify Asset Management. Michael, I guess, what's your assessment in terms of how we're set up heading into final 5 trading weeks of the year, and what that then will tell us about some of the momentum that we could see for markets in 2024?
Well, I think you nailed it when you hit the topic of renewed flows into the equity markets. In particular, we've seen a tremendous number of portfolio managers that had expressed relative caution. And I would actually highlight that the flows appear to be coming from institutional and registered investment advisors. There doesn't appear to be a component that's coming from individuals as much as it is people who had been relatively cautious in their portfolio construction are now being forced to cover their shorts. We see that as positive flows, even though that money is already in the market. It was simply sitting in cash or cash-like instruments. We've moved from an underinvested position to what increasingly looks like a potentially overinvested situation, exactly as you described in the February 2022 type framework. This doesn't feel like a renewed outbreak of optimism as much as a renewed outbreak of nihilism, in which people are simply saying, man, I don't know.
And what would you attribute kind of most of bears being out of their league to? Is it perhaps, and what we've heard at least coming into this week is that for anyone who's still calling for a recession, you're starting to sound like the boy who cried wolf. Is that the case here, or is there something else at play?
No, I think that's absolutely the case. And I think what we have seen broadly, you've seen Jim Chanos shut down Kinnikos. You've seen Dan Loeb announce that he's stopped shorting. You've seen David Einhorn announce that he's going to stop shorting. Right? We've seen these behaviors over and over again as people have simply said, I can't understand what's driving markets higher. Most people that are in this situation will acknowledge that a lot of this is simply a function of mechanical flows that are either occurring due to passive investments or systematic and algorithmically driven strategies. There's very little thought that appears to be going in. We're seeing a market that's increasingly just dominated by these mechanical implementations.
So, Michael, how should, I guess, break this all down then for investors in terms of investors trying to position their portfolios heading into the new year? What should they be favoring?
Well, I think this is an interesting opportunity where thoughtful retail investors in many situations are at an advantage versus their peers in the institutional space. They don't actually have a required allocation. So if I give money to a credit manager, they're going to have to put it into credit. If I put money into a Treasury fund manager, they're going to have to do it. Or if, like roughly 94% of Americans at this point, the vast majority of my retirement flows are going into something like a target date fund in which nobody's making an allocation. It's simply being applied in a proportion to what a historical model would suggest given my age. You have the chance to actually change that and be thoughtful about the extraordinary change in yields that has been created and reallocate portfolios in a thoughtful manner that meet your investment objectives rather than simply something that's tied to historical return profiles. So I would encourage people to take a look at the radical change that's occurred in interest rates over the past 18 months that the Federal Reserve has actually told us are unsustainable and designed to slow the economy. And yet, ironically, people have really not tried to change their allocations, particularly on the institutional side, because of the rigidities that are built into the system today.
To what extent have we already seen many of these short positions then betting against the market close out? And does that mean we're still anticipating some of that to come forward, thus kind of adding more fuel to a rally going into the year end?
Unfortunately, I actually think it plays in the opposite direction. There certainly can be an impact of a January type effect where we see bonuses and other components that are contributed to flows. But I think that there's some really important signals that are coming out of the marketplace. We've seen IBM move from a 401k match to a fixed income allocation. Now, that's obviously for IBM's benefit, but we're starting to see the rumbles of significant changes in portfolio construction and design to take advantage of the much higher interest rates that we currently have today. We're simultaneously seeing a market that is composed of the best of times for many of the largest stocks that are aggressively buying back their shares with the very high cash flow that's being generated by their super profitable businesses. And at the same time, if I look across the market in total, the median stock, the vast majority of stocks are actually down. The Russell 2000 equally weighted is down over 6% for the year. That feels completely incongruous with what we're actually seeing in market headlines about a raging bull market.
All right, Michael Green, always great to get your insight. Thanks so much for hopping on with us this morning. Chief Strategist at Simplify Asset Management. Thanks.
Thanks.
Cooler inflation data has fueled a market surge over the past few weeks, with investors hopeful that the central banks are done raising rates and may begin cutting by mid-2024. The S&P 500 has risen almost 8% so far this month, and folks are looking to cash in. Since October 9th, investors have poured nearly $40 billion into stock funds, the biggest two-week inflow that we've seen since 2022. This is according to latest data out from Bank of America, and specifically looking at where some of this money is flowing into. Technology, we know, has been by far the leader of the market, really the reason that the S&P is up just about 19% heading into the final 5 weeks of the year, and tech recording its biggest inflow over the past 12 weeks. So, Brad, investors still finding reason to buy some of these names that have been leading the market here throughout the year. Yes, we did see some pressure going back to August and September, but we have seen a bit of a resurgence. And taking a look at a lot of these 2024 outlook calls that we've gotten from strategists over the last several weeks, many of them who do see upside potential in the S&P many of them do see technology driving that momentum.
Yeah, I think back to our conversation with Wei Li from BlackRock earlier this week, and it said that there's still potentially more upside to think about when you have to consider the Magnificent Seven. And I believe what specifically she had talked to about us in those Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla. But what she had said was that they're currently still overweight. The theme, the Magnificent Seven, played a big part of that. Also saying that it's very different from the dot-com bubble. And if you look ahead to 2024, actually earnings expectations of tech driving 50% and more of those high single-digit earnings expectations. So all that considered really dovetails back to what you were saying about tech a moment ago. And even as we've seen where investors are putting their money into stock funds, about $60.5 billion, according to the BofA research note that they had put out, went into those stock funds. And I think technology still, from what we've heard from multiple firms now and trading houses, it continues to be a tech lean, especially given a lot of the demand that has been that has come to light around not just generative AI, but where a lot of these companies still sit on massive cash piles to deploy both acquisitions strategically or be able to grow out some of these solutions in-house and be able to take them directly to a client base for some of their most high-margin businesses that they operate.
Yeah, certainly. And taking a look at these flows, we do see a lot of optimism heading into the final month of the year and then looking ahead to 2024. Yeah. But so much of this really hinges on what we're going to hear and what we're going to see the Fed do in the new year in terms of how long this higher for longer rates strategy is going to be at play. And then, of course, the pressure that could potentially put on some of these equities here going forward. All right, well, shares of Fisker are on the move today after the company submitted its quarterly report, which showed that it's in compliance with NYSE listing requirements. Last week, the company received a notice that it was not aligned with NYSE standards because of a late filing with the SEC. We're looking at gains of just about 3% in early trading. Now, digging into this in the 10Q that was released after the report following this delay was that some expenses were incorrectly recorded in the prelim results that Fisker did release. $4 million of an increase in net losses here. They also have named a new executive vice president of finance and accounting. The company has gone through 2 chief accounting officers in just a month. We know delivery, production, the strategy surrounding that for Fisker has been a big focal point for strategists, for analysts over the last several quarters. Looking ahead, demand and production issues are likely going to be the driver of stock price here. At least at this point, we're trading just over $2 a share. Fisker does not own its manufacturing plants. It's operated by Magna International. And I bring that up because so much of Fisker and the direction that we have seen with the stock is a result of production and demand and delivery numbers. And the fact that they don't control that could kind of keep them a bit range bound here, at least in the short term.
Yeah, absolutely. I mean, look, the company has a lot of great names for their vehicles. The Ocean, you've got the Alaska, you've got the Pear, the Ronin. I mean, that's all great and dandy, but at the end of the day here, this is a company that had gone public via SPAC. It's seen itself just trim all of those and decline into a lot of obscurity that we've seen here at this point in time. There's a larger question, or at least there was, about whether or not it would be delisted at some point. Fortunately, at this point in time, it seems like the financials that have come forward start to clarify that a little bit more and what they're actually expecting going forward. But then at the end of the day, too, you got to think about where we've seen for the electric vehicle landscape, some of the largest manufacturers also pull back on their own not just development, but their production and their delivery kind of timelines and their milestones. Ford was one of them that recently had come about. And that is the demand environment right now. When you've got it being such an expensive purchase for so many and a financed purchase, the credit conditions right now don't really set up for a purchase like this. And then additionally, you're still waiting for much of the network for charging to come online too. And so that's where it seems like a little bit more of an antsy environment for some of the potential buyers sitting on the sidelines of this as of this point in time and impacting some of the timelines for major automobile manufacturers and then Fisker as well here. Also, we got to talk about Chinese electric car maker BYD. I was tracking this one this morning. Said it launched its flagship sedan in the United Arab Emirates this week. It's not immediately clear when the deliveries will begin, but BYD is the market leader in China. That's worth noting. It delivered over 151,000 fully electric vehicles in September alone. It also recently crossed the threshold of 6 million new energy vehicles rolled off the production line. That's at their Zhengzhou factory. And so they said that this momentous occasion, record-breaking achievement, underscoring the unwavering commitment to pioneering advancements in the electric vehicle industry. And it's probably something that they're saying because, well, one day they hoped it's extremely profitable for them long term.
They do hope it's extremely profitable for them long term. A lot of this obviously also hinging on demand and exactly what that looks like. When you mention BYD, there's also a report out today that's putting some pressure on Tesla this morning, but this is tied to price cuts here, potential reports here that the car maker is planning to offer steeper price cuts for their Dynasty models as they do look to boost some demand for their own EV vehicles. And obviously this would just extend the price war that we have seen play out in China and really across the world when it comes to making EVs a bit more affordable, a bit more competitive in order to really propel that Main Street adoption that we've been waiting for now for quite some time.
Yeah, these price wars have been remarkable to track, especially region by region, Tesla and Elon Musk, and the initiation of much of that, but still at a time where consumers in both of those regions are trying to figure out, okay, what is actually a good price? And many of them actually may be doing so much work to cut price just to get people into that ecosystem and perhaps get them into a trade-in, trade-up type of relationship over that longer customer lifetime value. Also here, we're tracking Vista Outdoors this morning, evaluating a takeover offer from firearms maker Colt CZ. That group and that values the company at $30 a share. This offer comes after Vista announced a merger deal with the Czechoslovak Group, which is a Czech industrial technology company, in October here. So this, most notably here, we were continuing to take a look at Vista Outdoor shares. They're up by about 4.4% right now on this announcement.
Yeah, we'll see what happens with this competing offer, which again was unsolicited. When it comes to some of the comparisons there, Vista Outdoors releasing a statement saying that their board of directors are going to carefully review the Colt CZ proposal and that they do remain committed, obviously, to acting in the best interest of Vista Outdoor shareholders here going forward. We're seeing a bit of a reaction in shares this morning, at least, of Vista Outdoor. The stock up just about 4%. You mentioned that all cash and stock merger valuing the company at $30 a share. Of course, the question is how that stacks up to the competing offer and agreement that they have already made and exactly how this all pans out for the company here going forward. All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. You're watching Yahoo Finance. Oil prices under pressure this morning after OPEC Plus announced that its next meeting is going to now be held online November 30th. It was initially meant to be in person, but was delayed. Now, the move did raise some concern here among investors. Speculation now swirling over what the production outlook is going to look like. We want to bring in Andy Lipow Associates president here, joining us for more on that. And Andy, when you take a look at the landscape, all the reports that we have seen over the last several days, just about the fact that we have seen a delay in this meeting, that they couldn't figure out an agreement in terms of production. How do you see production policy from OPEC Plus shaping up as we look ahead to 2024?
Well, thank you very much for having me. What we've seen is OPEC Plus has been increasing their production over the last several months, and that's been led by Iran, Iraq, Angola, and Nigeria. And this is at the same time that the burden of the oil market has been falling on Saudi Arabia's shoulders with their production cut of 2 million barrels a day. So as we go forward, there's now disagreements because you have countries that want to increase production, and that's going to include the United Arab Emirates, who's gotten an increase in their quota. At the same time that you're seeing these lower oil prices, and these disagreements between Saudi Arabia and the others have led to this delay we've seen for the next 4 days.
So do you anticipate then, if we see supply cuts on one end going into next year, but then on the other side of that, you mentioned non-OPEC countries who are looking to ramp up production as well. What does that net out for some of the price action that we're expecting to see?
Well, I think this puts OPEC Plus in a difficult situation when you see record oil production out of the United States of over 13 million barrels a day and significant increases out of Guyana. And you layer that with the potential return of Kurdish oil production if Iraq and Turkey and the Kurds can get an agreement on the export pipeline. So overall, I think over the next couple of months, we're going to continue to see pressure on oil prices. And that's really going to force OPEC Plus to either maintain their voluntary production cuts well into the first part of 2024, or actually they could surprise the market once again and announce a 500,000 barrel a day production cut.
What would that then do to the price of oil there, Andy?
Well, it certainly would move that oil price back up for WTI to about $80 a barrel and Brent for $85 a barrel, because it does show that OPEC and especially Saudi Arabia is serious about getting the oil price higher because their budget deficit is growing at these lower levels as they have an ambitious program to spend money domestically.
You know, when we think about the Fed and their policy pathway forward, this is one area that they don't have an arrow in the quiver for, because it's going to be largely driven by some of the OPEC plus countries, as well as some of those that are non-OPEC that are trying to bring up their production status, as we were mentioning a moment ago. And that's something that's going to impact prices all the way through to some of the more inflationary parts of the economy that the Fed does not have any control over this particularly. So, you know, how does that also pass through to the end prices that consumers might be paying?
Well, you're right that the Fed doesn't have control over the oil prices, but these higher interest rates that we're seeing for a longer period of time are going to result in lower demand or dampening any demand growth that we're seeing. When we look over into the European Union, we are seeing that oil demand is slowing down. In China, the refineries are processing less as a slower economy over there is impacting them. And if the consumer stops spending or slows down their spending here in the United States and buys less goods and services, of course, that's going to impact on Chinese manufacturing and the rest of the world. So from that standpoint, these higher interest rates for a longer period of time are bearish on the demand side.
Andy, when it comes to who's best positioned now within the energy sector as we look ahead to the next several months, is it the large energy players that have been investors' favorites when you take a look at Exxon, Chevron, especially in light of the recent acquisitions that they have made? Or are there maybe some smaller players that are more positioned or in a better position to benefit given the dynamics that are at play?
Well, certainly Exxon and Chevron have seen all the news headlines with their major acquisitions. And what we have seen is oil producers as a whole are doing more with less. The Baker Hughes rig count is down about 20% compared to this time last year. as oil production continues to rise. But there are still a number of smaller producers out there, such as Diamondback Energy, who are operating in the oil patch. And there is, of course, people thinking that perhaps we could see additional consolidation in the Permian Basin.
Andy, thanks so much for helping us break this down and appreciate the time this morning.
Thanks for having me.
Certainly. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Keeping an eye on Tesla this morning, the company dealing with an escalating strike by a group of Swedish unions, with Elon Musk branding the fallout as, quote, insane. This comes amid mounting pressures on the EV maker as it faces a pricing war with EV competitors' shares moving higher by about 0.7%. You know, I think for Tesla, this is not perhaps the best time for any news around a strike to really ensue, especially considering the fact that they are in the sight, not just of some of the labor regulators that are overseas, but also here in the U.S. as well, as that is the UAW's next target, as Sean Fain talked about.
Yeah, certainly. We know that Tesla has been facing some pressure here just in terms of their workforce and what we could exactly see play out here over the coming months, given the UAW strike and how effective many, I think, would say that they were in terms of reaching more favorable pay benefits for what the union was pushing for. In terms of what the strike means for Tesla. So the strike in Sweden right now, it affects 7 repair shops. With this expansion, with postal workers now involved, dock workers, the list goes on. It now totals about 9 unions are part of the strike on Tesla. So it has started affecting Tesla operations within Sweden. We did hear from Elon Musk. He weighed in on X about this strike, calling it insane. Obviously, he's not happy with exactly what this means for Tesla over in Sweden, and more specifically with the post workers now being part of the strike. It has now prevented a Swedish transport agency from delivering license plates to new Tesla cars, which means that then Tesla cannot deliver the vehicle. So obviously having a real impact there. And this comes at a time when Tesla has been under a tremendous amount of pressure. We talk about the number of price cuts that have already taken place, the pressure that has placed on margins. Yes, in some way, it has been a boost for demand, which many analysts, I think, would agree is short-term pain for long-term gain. But that short-term pain, especially when you're facing work stoppage or any sort of pushback here from union workers overseas, the potential that could then trickle here into the U.S. is just another headwind that Musk needs to keep on his radar.
Yeah, absolutely. And I think one of the other things to track continuously with this as well is where this perhaps permeates into other areas in Europe. Particularly, I think about that Berlin Brandenburg factory. That is the first gigafactory that they brought online in Europe, and they really prioritize manufacturing hundreds of thousands of Model Y vehicles and their battery cells there. And that is going to be a huge footprint in order for them to be able to deliver into other parts of the European region and member countries. Now, all of that said, we've been in the midst of the year of some of the most tense labor negotiations across healthcare, across entertainment, and across autos as well. And that's why for Tesla to continue to be within this conversation, or at least in the orbit of this conversation, could spell out something that investors have to watch, as it could impact the margins, even as they have been imploring, or I should say, just rolling out a lot of those different pricing options and cutting the prices in order to make sure that more sales are done in this interim period of time. But those sales could come at a risk, especially if you do see successful labor negotiations and strikes move forward, which then move higher some of the costs to produce, and then ultimately impact the margins that they're able to see at the end for each vehicle sold as well.
All right, we will see. Tesla certainly has been one of the winners this year, but has been under some pressure here as we take into account all the pressure that margins have been under because of the price cuts that we've seen play out. All right, keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned.
Stocks in muted mode this morning. It's half day for the equity markets on this holiday weekend. The Nasdaq and the S&P 500 looking for their longest winning streak since June.
Well, on the movers front, we're watching shares of Novo Nordisk, the company behind the blockbuster Wegovy weight loss drug, and now planning to invest over $2 billion to expand production in France. It doesn't stop there. It's also looking to launch Wegovy in Japan on February 22nd. That is the first launch that we would see of this drug in Asia.
And Barclays is also on our radar. According to Reuters, it's working on a plan to reduce costs by as much as $1.3 billion over several years. That strategy could involve cutting as many as 2,000 jobs.
And Xpeng is surging today as other EV makers are in the red. Its newly unveiled G9 was awarded Technological Frontrunner of the Year at the Danish award show Auto Awards in 2023. Now, the Chinese automaker has exploded this year with shares up just about 75% since the start of the year.
All right, mazel. It's Black Friday, which is expected to be the most exciting shopping day of the year. But is that still the case for the in-person experience? According to MasterCard's Holiday Spending Pulse, total retail spending is expected to rise 3.7% over the holiday season. But this will be mostly driven by e-commerce, not in-store sales. So, is the mall shopping experience dead? Oh, that's grim. Here with the latest trends is Steve Sadove, who is the MasterCard Senior Advisor and former Saks CEO and Chairman. Steve, great to get some time with you here this morning, and a happy Thanksgiving weekend to you. First and foremost, when you think about some of these trends that you were able to pull out of this Pulse Insights here, what is the first thing that really perhaps comes to mind for you that gives us a sense or kind of tells a story about the consumer?
Well, great to be with you this morning. You know, I think when I look at the numbers, it tells me that we have a healthy but cautious consumer. The consumer's spending again, 3.7% growth is real growth. The inflation rate is about, let's call it in that low 3 range right now. So the consumer's getting essentially flat unit growth. And that's where we've been over the last couple of years. If you look at pre-pandemic, you were seeing 3 or 4% growth, so that we're back to that kind of growth. You had very inflated growth a year ago, but inflation was 7 or 8% growth. So I think the consumer is spending, but they're being very cautious. Value is an important word. They're spending, as we all know, a lot more on experiences and less on stuff. The e-commerce business is healthy again. You know, we had a period during the pandemic when everybody was just shopping e-commerce. You had this massive growth from about 12% to 18 to 20% of commerce in being done online. That then slowed down dramatically as the world opened up and everyone wanted to get back in a store. Now we're into what I would call a more balanced growth. Prior to the pandemic, e-commerce was growing a bit faster than stores, and that's the experience that we're seeing right now.
So, Steve, how are retailers adjusting, and those that you think are best positioned at this point, what have they done in order to maybe advance their business or adapt to some of the shift that we've seen from consumers in their spending trends than some of their peers?
Well, I think there's a lot better control of inventory right now. You know, we had a dislocation of inventory during the pandemic. The winners, the early pandemic winners, ordered much too much of the products that were selling well. And you now have the basically reversion to the mean, and everybody is having a better understanding of what is selling. Inventories coming into this holiday season are relatively lean, which means the promotions are going to be there, but they're going to be a little bit more controlled. If you go out there at Black Friday today, you're going to see discounts, but they're going to probably be in the 25-30% range as opposed to some of the very deep discounts. Little bit of wait and see. This is a very big day that we're out there with today at Black Friday, but it's not just about one day anymore. Consumer is shopping anywhere, anytime they want to be able to shop. Tech is doing well. Experiences continue to be very strong. Things like restaurants have been killing it. And right now, people are shopping a little bit less at the, for example, at the higher end, luxury jewelry, largely because experiences are doing so strongly. But again, all of these are a convergence to because some categories won early on. Everyone looks at a Home Depot, you know, not an individual company, but hardware, home related types of of companies did very, very well during the early stages of the pandemic. They're comping much higher numbers. So what I'm seeing is a balance going on, but the key word being value. The consumer is very much focused on that. They're also focusing on what I would call peaks and valleys in the season. This was an early season. You started to see promotions starting early in mid-October. You're seeing big promotional pushes. So I would expect a big peak this weekend and through Cyber Monday. You'll probably see a valley as you go out of that week, and then a big push probably the Saturday before Christmas and then after Christmas. This is a long holiday season. This is the best calendar for retailers in terms of the number of shopping days. So again, I'd see a lot of promotions, but what I would call planned promotions on the part of retailers.
You know, Steve, given your background as former Saks CEO, you know, when you see a consumer environment like this, where we've continued to talk about or hear about trade downs among the consumers, and looking for discounts, as we've just discussed here, does that type of environment make for a high value, high cost nightmare for some of the most luxury goods producing companies?
Not necessarily. I think that you've got to look at segments of the consumer. The lower end consumer, low to middle end consumer is much more stressed. They've been having to deal with the lack of government payments, support payments. You now have loan repayments. I think that we've had the excess savings that are being drawn down. So you're seeing much more in the way of the trade, what you're calling the trade down, or making choices among that consumer base. The high-end consumer, I always saw it as being very tied to how are the markets doing. That consumer is really quite healthy. They're making choices in terms of whether they want to buy more things or whether they want more experiences. You've seen a very big uptick in the last year of travel, hotels, cruises, things like that. So the luxury goods market has slowed. Clearly overseas, China has affected that to some degree. But in the U.S., I don't see a major trade down among the luxury consumers. I think it's a matter of choices for them.
All right, Steve Sadov, always great to get your insight, especially on a day like today with Black Friday. MasterCard Senior Advisor and former Saks CEO and Chairman. Thanks, Steve.
Thanks.
Keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
Bitcoin jumping today, as Destiny's Child would say, hovering just under $38,000 on this quiet holiday weekend. We have Jared Blickery here with the latest crypto news and perhaps his favorite Destiny's Child song as well. Hey, Jared.
Hey, Brad. I'll skip the musical puns for now. If we have any time on the back end, I'm happy to cycle through them. Talking about Bitcoin, had a chance to just take a quick look at the price in the previous hour. As you said, right around 38,000. Now, these are the prior highs from 2021, still well off of those, but I like this longer-term chart because it shows where all of this overhead price action has been. This just adds as a natural resistance layer. Nevertheless, Bitcoin has started to power through it, and so far we haven't seen too many signs of net selling activity really rip into the trend. And the trend here, as I've been saying this year, is definitely to the upside. Also, there's been some circulation, some news about Cathie Wood selling some Bitcoin in one of her ETFs. And this would be the ARK Internet, the next generation Internet ETF. And I just wanted to show, this is a chart that goes all the way back to the late 2014. This is how much ARKW, that is that next generation Internet ETF. That is a position in GBTC, that's a Bitcoin proxy in the stock world. This blue line right here is a position value, and you can see currently well off of this high right here, north of 2.5 million, or actually north of $100 million, but it has been trending up, and that is since the beginning of 2023. Meanwhile, she has been selling into that. That has to do with the price rising. And as the price has been rising, I believe that the fund has been taking in a little bit too much ARKW, or at least it's been taking up too much of a position size. So as Cathie Wood has done in the past, she has sold some of that, trying to keep that position size under 10%. And I thought it'd be interesting just to take a look at some of Cathie Wood's funds and how they've done, because recently they have really picked up, and this is what's happening today, ARKG in the forefront, but I want to show you what's happened over the last month. ARK Innovation, that's RK, that's up 21%. That is the number one performer here. Then we got the FinTech ETF up almost 19%. ARKW, that was the one we were just taking a look at, the Internet ETF that has GBTC in it. These have really come to life. And I just wanted to show, if you take a look at how far off of these are, how far off these funds are from their highs, you can see ARKW is the least worst off. While if you take a look at how much they've rallied off of their lows, ARKW has been the most profitable here, even dwarfing the incredible run that RK and ARKF had. So bottom line here, it looks like Cathie Wood's finally benefiting from this price rise that we've seen in Bitcoin, and just kind of making sure that her long-term estimates for Bitcoin are just kind of in the public consciousness. They've always been up there. I think that's what I'm dancing around right here, but are they far-fetched? Hard to say. We'll have to check back in a couple of years.
Yes, Destiny's Child would say, I'm a survivor.
Thank
Jared
you.
Blickery, thanks so much. Appreciate it. All your market action ahead live from well, no, we're not there. We're here at our home court. You're watching Yahoo Finance. That's Times Square.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
We've heard his name a lot this week, Sam Altman. He's now back as CEO of OpenAI after a brief ousting from the position by the former board. Now, investors are closely tracking these developments, namely for what it could mean for the generative AI space, which has dominated technology and business this year. Now, with Altman's return and new faces on the board, what does this mean for the future of OpenAI and more largely for the AI space? We want to bring an author, advisor, and a speaker specializing in the generative AI space, Nina Schick, here to discuss more. Nina, it's great to have you. So I'd love your perspective on everything that has played out over the last week, all starting last Friday, just about a week ago, when we got news that Sam Altman had been fired from OpenAI. Now he's back at that top job in that position. What does this mean for OpenAI and the future of generative AI?
Well, what a drama the last week has been. This has been the hottest story in tech, not least because nobody saw this coming, right? Including Sam Altman. Why was he fired? And it basically looks like it came down to what I think is going to be a prevalent trend going forward for the development of artificial intelligence. You can almost see it as a schism between the doomers and the boomers, the rush of those who want to commercialize the new capabilities we've seen with artificial intelligence and those who are saying, hey, wait a minute, this is dangerous. We should rethink these capabilities, so we should think about safety first. With regards to OpenAI itself, I think that this has harmed their image because they were the poster child for generative AI and these new capabilities of AI that we see emerging. And yet the whole coup and then reinstatement of Sam Altman made them look quite amateurish, right? And the fact that he was only reinstated because basically the entire company threatened to walk. I think some of that initial sheen that they've had over the last year with Sam Altman really being the wunderkind of AI, literally courting global leaders, some of that will have been lost. But of course, they will continue to develop these technologies. And now it looks like really look to commercialize them as well.
So Nina, at OpenAI, is the damage already done when you have this high profile of a fallout, then reinstatement, and ultimately a shift that we've seen, it seems at least from the outside looking in the corporate culture and trust in some of the leaders at the company up to the board level?
I think that is where they're going to be hit, right? With regards to trust, with regards to, their corporate governance structure. Like I said, for the past year, it's been about a year since ChatGPT came out. OpenAI has been riding high, and Sam Altman has really been kind of the epitome. I mean, he's a brilliant mind for, the incredible advances that are now happening in AI research. Since the breakthroughs that have been pioneered by OpenAI, but also other kind of AI frontier research companies have really come to the fore over the past 12 months. I mean, there has been a lot of intra competition between some of the companies, not only the big tech companies, but some of the other frontier AI companies. So I think that the incidents or what's happened over the last week with OpenAI will certainly serve them well. Other competitors like Anthropic, like Google, who isn't partnered with OpenAI, they will be looking to kind of move into that space, that kind of mythical space that OpenAI had occupied. So I think that, it hurts their brand. But will they continue to do incredible developments in AI research? Yes, absolutely. But it's a hotly contested space, and others will be stepping up too.
Nina, you mentioned, going back to what you just said a minute ago about commercializing generative AI. How does OpenAI, or I guess, what does that strategy, what does that approach look like when you're talking about commercializing generative AI, ChatGPT more effectively?
So, I mean, for OpenAI in particular, this has always been slightly a quandary, right? Because they were founded in 2015 with the mission to kind of protect AGI to develop AGI or super intelligent for the benefit of humanity. And what ended up happening last year was that they released an incredibly sophisticated large language model, ChatGPT, which for the first time, really started to show us the beginnings of the so-called intelligence revolution, the capacity for AI systems to be able to augment and plug into human intelligent and creative processes, right? So for ChatGPT alone, for the past year, I've been speaking to multiple businesses who are thinking about how can we deploy a large language model like this within our organization for efficiency, for cost cutting, and actually, can we use something like this also to generate revenue? Can it help us come up with new strategy, with new ideas, with new predictive analysis? And that's what we've been seeing over the past year, not only with OpenAI and its ChatGPT product, but really the development of large language models across kind of the spectrum of big tech and frontier AI companies. So it's also worth remembering that large language models are the rage today, but they're only one kind of generative model, right? These capabilities are going to continue to increase, not least because the incredible amount of talent flowing into the space, as well as the money and the fact that pretty much all of big tech have become AI first companies. So I think we will continue to see these capabilities being developed at an exponential rate, as well as the adoption curve being higher than any kind of general technologies we've seen in the past. I think it'd be bigger than the internet. So when it comes to the world of work, and where the applications will be, that's really like asking how long is a piece of string. Because when you think of AI, it's more a meta technology than a technology itself. It's the technology that's going to enable platforms. It's going to enable applications. It's going to enable tools and products. So that's really what I see happening in the next few years with AI.
Yeah, my family was certainly trying to rage on large language models over Thanksgiving, but we got distracted by that food, Nina. Just lastly, while we've got you here, I got to ask, when you've got this type of partnership that Microsoft announced earlier this year with OpenAI that came with a very hefty sum of capital that they're putting towards making sure that they've got the ability to develop on top of what OpenAI has already been able to introduce into the market. OpenAI burning through a lot of cash right now to make sure that ChatGPT can still run and everybody could run some kind of, just boneheaded search queries at times. But at the other end of this, you've got a company in Microsoft that looks at this play out. Do they lose confidence? Do they have any of that waver given the structure at OpenAI right now?
Well, I mean, the kind of word going around was that Satya Nadella, the CEO of Microsoft, who actually, I think, emerged in this crisis looking almost like the only adult in the room, wasn't told, about what was about to happen before Sam Altman was fired, and that he was furious. Nonetheless, I think that they will continue to work with OpenAI because the fact of the matter is that they have built an incredible company that has pioneered sensational breakthroughs in artificial intelligence that have, in a short space of time, completely changed the landscape and have completely changed the world. I mean, the release of ChatGPT will be a historically seismic moment. And although there is a lot more competition, it isn't only the partnership between Microsoft and OpenAI. You see lots of flourishing partnerships. For example, Google's with Anthropic, or even if you look at who AWS is partnering up with, or the work that other companies like Meta are doing, there's enough kind of gains to go around. It's what is more interesting for me is just how much impetus and market-moving impetus there is with regards to the attention that all of big tech and frontier AI companies are doing now to actually really commercializing these capabilities.
Yeah, fascinating insight and analysis as always. Nina Schick, who is the author, advisor, and speaker specializing in generative AI. Nina, great to see you. Thanks so much for taking the time. Thanks. Well, investors are nervously eyeing what happens today as Black Friday kicks off what is traditionally considered the start of major holiday shopping. Our next guest says that retailers are no longer reliant on Black Friday and Cyber Monday deal days that we've all seen, as holiday shopping has started earlier this season. Let's bring in JLL President of Retail, Naveen Jaggi, to discuss more. Great to see you, Naveen. Help us break down what you're seeing from your perspective here and the expectations going into this holiday shopping season versus years past.
Oh, well, good morning. Pleasure to be here. I think the first thing we can note is the holiday season for most retailers began in October, not Black Friday. I think Black Friday is the official kickoff period, but retailers started promoting quite heavily into mid-October. The reason why is because they were trying to capture that dollar by the U.S. consumer, which we notice is pulling back a bit over the past 2 months. So how do you get their attention? By making those promotions start quite earlier. To me, that's a good sign. Now, as much as we keep talking about sales turning negative and consumer sentiment moving southward, here's what I will say. The U.S. consumer is as resilient as ever. And they prove time and time again that they will spend when they've given the opportunity to spend. And no better example than when we came out of the pandemic in 20, and we saw the whiplash at a massive 16 to 70% year over year in holiday sales from 20 to 21 to show, look for the U.S. consumer to surprise us this holiday season. I predict between 5 and 6% above last year trends.
Naveen, what are you seeing at JLL just in terms of leasing activity from retailers and how some of their strategy maybe has shifted or adjusted as a result of what you were just saying in terms of what consumers are spending on and some of the changes that we saw take place during the pandemic?
Well, I think what we're seeing, first of all, is leasing volume, broadly speaking, nationally is down about 12%. Now, where is that reflected? Well, that's reflected in your standard soft goods and your big box retailers not signing as many leases for 24 as they did in 23 and 22. However, what we are seeing is a continued shift of spend away from hard items, products, furniture, electronics, and experiences. And we've read about the Taylor Swift impact in those markets. We've heard about Beyonce and U2 and others. People are traveling more, as the airline industry stocks will show. So I think right now, more than anything else, we're starting to see U.S. consumers over the last 12 months move to more experiential retail spend, which isn't unexpected after being shut down and locked down for coming on 18 to 24 months, depending on where you lived.
Yeah, look, I, for one, cannot wait to visit the Sphere in Vegas. So I think many people who have been able to contribute to and take part in the experience economy, they've no doubt enjoyed it, but this certainly has impacted some of the goods producing and product side of the industry. And when you think more broadly about where the consumer health is sitting right now, how would you describe the consumer health from your perspective?
I think the consumer health is actually quite good. And here's what I'll say. Look, every year we've seen, every 4 years during an election cycle, consumers get a little muted in their spend. So now we have 2 wars going on in the Middle East and in Eastern Europe. Now we have an election cycle coming up in the next couple of months. First primaries, I believe, 6-8 weeks from now. That usually sends a signal to the U.S. consumer to wait, watch, and see what happens to the economy. And so the consumer is fairly healthy. I think that we're entering a cycle that, combined with a lot of forces, is going to see some muted retail sales over the next roughly 6 months. But I would look forward to a really sharp uptick in sales in the second half of next year, most likely lined up to an anticipated interest rate cuts.
I mean, in terms of the outperformers of what you're seeing from those who lease from you, who is outperforming, who's best positioned? And for the consumers that are still spending in this environment, what are they buying?
Well, we've seen some really good numbers coming out of retailers like Abercrombie, and I think that's a good example of a retailer that's done quite well. Lululemon does quite well. I think when you see these retailers that have shifted the way they market to the consumer, and they give the consumer a specific experience and a very, very connected experience to their brand loyalty, brand alliance, that's one sector I continue to think I believe in very heavily. Number two, you can't minimize the value of the discount retail sector. Ever since 2009 and 2010, we've seen the discount retailer, the value retailer, take more and more share away from the legacy retailers. So whether it's Ross Dress for Less, TJ Maxx, Burlington, we continue to see those brands grow and grow and more. And they're taking those sales away from whom? Kohl's, Macy's, as 2 examples. Meanwhile, I look for Walmart and Target, who is the kind of the bread and butter of retailing in America. I see them continue to do well in 24 and 25.
At the same time, when you think about all of these, both the names that we had up on screen and some of the names that you mentioned as well, they're trying to trim overhead or at least be extremely cost disciplined wherever possible. Has that led any of them to come back and look for more favorable lease terms, look for more favorable terms that give them the opportunity to reduce some of that overhead right now?
Many retailers actually restructured their leases back in 20 and 21 as the pandemic really hit hard in the retail community, as we all saw living through it. They restructured their leases. It's very difficult for a retailer to restructure leases in 21 and come back in 23 and 24 and do it all over again. Healthy retailers made those adjustments. They've got their lease terms fixed and settled. They did some blend and extends, an example, to get some more term on their leases. To see that happening again in 24 is probably not likely. You'll see some of it happen, but I think mostly the retailers have fixed their fleet for the long term. And now we just have to go through this kind of what I call muted environment as we go through the election cycle and look to the 2024 midterms afterwards into October, November, December, we'll see IXIC good retail sales.
Naveen, always great to get your perspective. Thanks so much for joining us here. JLL, President of Retail. Thanks.
Thank you.
Keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back. Thanksgiving yesterday has many of us feeling just a little bit sluggish and maybe starting to think about the holiday season getting back to the gym. Well, the gym and fitness industry we know is entering a very critical time. It's worth about $7 billion with several franchises and companies vying for consumers. So do hiring practices and also locations of those gyms impact consumer experience. Like many fitness franchises, Orange Theory has been innovating its classes and adding locations to push growth this year. For more on this, we want to bring in Dave Long. He's the CEO and co-founder of Orange Theory. Dave, it's good to see you. So first, before we get into some of those growth plans, I'm curious, just taking a step back a bit, where does the fitness space stand today? We talked about so many of the changes that took place during the pandemic. How is what you're seeing today compared to what we saw 3 years ago?
First of all, happy Thanksgiving. Great to see you. I think it's been a consistent shift back to understanding that consumers want in real life fitness. It's a really important part of them getting the results they want, being accountable to show up, and also the communities that surround great fitness studios. Although digital is still alive and not going anywhere, I think there's always going to be a blend. But what we're seeing as a cornerstone for most of our consumers is the in real life portion of this.
Dave, I always love getting your insights on the fitness space here, because when I think about my own experiences, and I've been to a couple Orange Theory sessions. I went to one most recently, and our team knows this very well, Birmingham, Alabama. And it's amazing how replicable the experience is across locations here and what your staff is able to do. But all that considered, when you think about pricing mechanisms, especially in some of these different regions where consumers are thinking about how much they're paying for a single class, or if they're getting a package, or just how much they're spending into that experience, have you seen that have to moderate, especially given the fact that many consumers, perhaps around the Thanksgiving table this year, inflation might have been a topic of conversation?
Yeah, it's a great question. It's been very top of mind for us. And we've even gone through some small price increases over the last 2 years. I would say we're probably still behind the curve of what a lot of pricing is for studio. And we have done a little bit more promotional activity. What we really understand is that we need to show the value to the consumer. And so, offering a trial class to come in and try it, or even a promotional offer for the first period of time has been really effective, because once the consumer comes through and they see how effective and different what we have to offer is, it kind of takes price out of the mix at that point. Whereas if they don't know what Orange Theory is and they're just looking at a price point, I think in their mindset could be very different. When
you say behind the curve in some of the pricing strategy, does that mean further price increases could be expected?
It's very much a regional outlook that we take, and it's something that, is looked at by the franchise network, because ultimately they have control over the pricing that they look at, a couple of times a year. Primarily what we're looking at is what are the things that we can impact to have our members have adherence, where they stay with the brand consistently, multiple times a week, because that's where they see the value, because they're getting the results. And when primarily what we're looking at is length of stay. How long does a member stay with us? And when they leave, how soon after do they come back? So that's really the driver that drives pricing and drives everything else that we do.
Dave, what are you seeing on the worker front in terms of the labor shortage? We've talked about that time and time again, affecting maybe some of your other competitors within the industry. Are you able to find the workers that you need at this point in order to run the number of classes that you had initially planned?
We are, and I think, we've built a reputation and a muscle over now 14 plus years of being just a fantastic place to work. Obviously, our franchisees govern and lead their staffs all around the world. We provide a tremendous amount of training that the franchisees deliver to really set up the staff for success. And we were talking about the fitness professionals, the coaches, because of that reputation, because of the way the structure is, they are able to impact a lot of members throughout the day and teach multiple classes. So the income streams and things for them are real and are important. And that's allowed us to have just a tremendous amount of retention with our coaches, our fitness professionals. Sometimes, front of the house staff that I think all retailers deal with is continuing to be challenging. But again, we're nuanced in that we're looking for folks that want to be part of a high energy brand, want to be outgoing and engage with members. And because of that, we tend to have really good luck finding the right amount of staff in each individual location. Also, it's all about culture. Our franchisees just provide a tremendous supportive culture at these studios. And again, that's often the difference maker, especially for the younger generations, is they want to go to a place where they want to be part of something special and have a positive interaction, during their workday.
Dave, just a fun one for you, and we only have about 15 seconds here, but the treadmill makes a big difference at a lot of these locations too. I've tried out a couple of your competitors, the treadmills, some of them manual, and then they, of course, have kind of the hybrid functionality with it. And it jumps a little bit when you're switching gears here. What is the strategy in making sure that you've got the equipment that people are going to want to come back, continue to use, and feel like they're getting a good workout? Because I don't know, man, I didn't love it. We did a class together recently too.
So it goes back to R&D and making the experience perfect for the members. We've been perfecting this treadmill with our partner for now 14 years. So making it the lowest impact on the joints, making it very responsive to touch controls, and taking member feedback. We get like almost 1 million pieces of member feedback a month. Everything from what they like and don't like about our treadmills, about our rowers, about every second of the class. We constantly use that feedback loop to improve not only the science-backed workout, but every piece of equipment, like you mentioned.
Dave, you just mentioned feedback, and that triggered my memory to something. I believe I read this about you, that you personally answer every customer complaint or every customer inquiry to Orange Theory. Why, and how are you able to keep up with all that?
It's funny. I was just looking at some of them this morning while I was here waiting, and most go to most of the franchisees and the studio teams, like 99.9% are being fielded, but sometimes people just want to reach out to me either through a social handle or an email. And, I just want to know that if they reach out, that I'm going to respond to them. Usually it's finding the best place for them to go so they can get the answer that they're looking for. And there's all types of questions about the workout, about their heart rates. And so I think that's what our brand's about, is about helping people. So for me, it's worth that time each day. And also I get a ton of just really heartwarming stories, and people just want to express what the brand has done for them. So it's honestly a lot more positive than negative, but even the negative obviously helps us get stronger and better.
Dave, fascinating work that you and the team do over there. We'd love to check back in the future. Dave Long, CEO and co-founder over at Orange Theory. Thanks so much.
Thank you. Take care.
Thanks, you too. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Today, Amazon workers are striking across Europe. Now, the Make Amazon Pay campaign is set to take place in over 30 countries starting today and running through Monday, coinciding with some of the biggest shopping days of the year. Now, the UNI Global Union is protesting against the e-commerce giant's working practices, demanding increased pay and also break time. It's also demanding that Amazon pay more in taxes and operate more sustainably. Again, like we just said there, this coming at a time that is so critical here for Amazon. They need all the help they need in order to get those orders that they're seeing starting to stack up over the last several days and looking ahead to the holidays, get them out the doors and to their customers. So any sort of hiccup like this obviously has a real impact of potentially impacting not only their sales today, but also going forward if those customers do have a bad experience of the fact that Amazon's being hit by strikes in Europe during Black Friday. Reason to be concerned here for investors.
Yeah, you know what? Europe hasn't always loved Amazon. They've faced a couple antitrust lawsuits in the EU, and I think on the labor side, especially in a region where, when you think about the differences between the EU and more broadly here in America, we tend to place more trust in some of the businesses than government. It's different in the EU, and they tend to place more trust in government than businesses, and because there's the assumption that there's going to be kind of holding big businesses accountable, especially when you look at the EU and what they've done with GDPR, making sure that there is more of a consumer-minded focus around this. A lot of that cascades into the thinking around the labor force participation too. And so we're seeing that kind of transpire here, at least within this kind of union worker strike in Europe, and we'll see what Amazon has to do to mitigate the impact of some of this too.
Yeah, we're seeing different demands play out from various countries. In England, they have just around more than 200 workers striking right now on Friday, on Black Friday. The company there, the workers there are saying that they're looking for pay to be raised to about £15, which would be $18.69 an hour. An Amazon spokesperson responding here to a Reuters request for comment, saying that their minimum pay starts between $11.80 and £13 an hour and is anticipated to increase up to £13 an hour in April of 2024. But still, Amazon workers saying it's not enough. Very similar to what we've seen play out here in the U.S. from Amazon workers specifically, but also we talk about the unions, the momentum that we have seen across the country here. A number of companies are trying to figure out what exactly the relationship looks like between their employees and themselves moving forward, and how to reach some sort of agreement, which is, one, to make the employees happy, but two, obviously not to pressure the margins too much of these companies when you're talking about higher pay.
Yes, step one, bring back cupcakes and Pizza Friday. Perhaps. We'll see if it works. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Today is one of the biggest shopping days of the year. The National Retail Federation projecting that over 130 million people are expected to shop today. But with the current consumer climate, consumers pulling back on spending, how much money should we expect shoppers to actually spend? We want to bring in Tom McGee. He's IXIC's CEO, joining us now. Tom, it's great to see you. So the trends that you've seen so far this holiday season over the last several weeks, how does that set us up then heading into the holiday season, heading into December?
Yeah, well, good morning. I hope you had a great Thanksgiving day. Our expectation for the overall holiday season is 3.8% growth. We expect a very strong Thanksgiving Day weekend. $130 billion spent, about 4% more than last year. 80% of people will shop today on Black Friday. 81% will shop on Cyber Monday. But the consumer will continue to be very focused upon inflation, the impact of inflation, looking for promotions. That speaks to the importance of days like today, Black Friday and Cyber Monday, and looking forward to Super Saturday, which are those big shopping days where retailers tend to lean into promotions. So overall, the same trends we've experienced over the last 12 months or so, which is the consumer has been resilient in the face of inflation, but a little more sensitive and looking for promotions. 70% of consumers will look for promotions, and that will dictate a lot of what they buy this holiday season.
How critical of a holiday shopping season is this for department stores and malls, quite frankly, Tom? Many of them who have been in focus because of the changing foot traffic or volume that these shopping centers had seen for decades, now starting to peter out, or at least start to matriculate over to some digital shopping that we've seen as deals get thrust forward there in a more direct-to-consumer environment. How critical of a shopping season is this for some of those operators of these larger kind of square footage retail spaces?
Well, the holiday season is always super important in retail, for sure, and particularly this period from Black Friday heading into Christmas itself. And so I don't think this year is any different than the past in that regard. The one thing that's happened over the course of the last decade or so is the holiday season has become longer. We look at the holiday season at IXIC as really beginning in October, extending through the end of December, because people do shop earlier now, and particularly in the face of inflation, they're looking for promotions, whether that's in October, November, and December. I do think this particular year, with consumer sensitivity around pricing being at its most heightened level over the course since for the last decade or so, that the next month or so will be quite important because the consumer is looking for promotions right now.
Do you expect promotional activity to pick up as we get closer to Christmas?
I do. I do. I think that I think retailers understand that the consumer is very price conscious. And you've heard a number of retail CEOs come out and talk about, the intention of looking at promotions to entice consumer behavior. So I do expect that to be the case.
Tom, also here, when we think about the spend profile for consumers at this point in time, I mean, we're looking at a vastly different mindset for some consumers who especially are on the lower income household side here too, who perhaps have been feeling like they've been in a recession going into this holiday season and months before that. So how do we expect that to impact the kind of overall sales that are seen, but also where other classes, the middle class particularly, as we had spoken with the JP Morgan CEO and Chairman Jamie Dimon, who had said the middle class might be next in that. Does that change the consumer sentiment vastly, and does that kind of protrude into 2024 from your perspective and estimation?
Well, I think a couple trends are happening, right? I think, many of the things that we're going to experience during this holiday season into 2024, we've already seen begin. The consumer is price conscious. And so if they're price conscious, they're going to look more towards discount retailers, discount department stores. And so I think that will continue and will probably broaden the population of people that look for deals and for discounts. But I do think as long as we're at historically low unemployment rates, as long as the labor market continues to be strong, the consumer will continue to be resilient. Because if you have a job, you tend to have confidence, and your spending will continue. If we start to see some erosion in the employment market, I think that could have a more significant impact upon retail sales. But in the absence of that, I expect retail sales to continue to be in that strong rate, solid rate through the end of the holiday season and into 2024.
Tom McGee, always great to talk to you, CEO of ICSC. Thanks so much for joining us, and happy Thanksgiving.
Happy Thanksgiving to you. Thanks for having me.
All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
U.S. existing home sales numbers came out earlier this week, and there was a significant drop as the numbers hit a 13-year low, falling 4.1% in October and 14.6% year over year. Mortgage rates also slumped a little over 7% from the prior week, with our next guest saying that it's stirring up buying interest and that housing inventory is set to improve after this winter and heading into the spring. And with more inventory available, there will be more home sales. Let's bring in National Association of Realtors Chief Economist Lawrence Yun to dig into what we can expect from the real estate market. Happy Thanksgiving weekend to you, Lawrence, and always great to get some of your perspective here. Put some of the context on this data here for us, because when we compare it to years and even a decade plus back here, it doesn't look too good.
Well, good morning. We are in a very unique housing cycle where homeowners are unwilling to list their property because they are locked in on those lovely 3%, 4% mortgage rates. They're all smiling. Their monthly payments are low. Their housing wealth has risen greatly. But the challenge is that with higher mortgage rates, it's really hurting the first-time buyers from entering the market. First-time buyers comprising less than 30% of all transactions. It should be closer to 40% in normal circumstance. So we have a divided market. Homeowners doing well, yet the potential home buyers, renters who want to be the part of the ownership society, are struggling to get into the market.
Lawrence, what are your expectations for mortgage rates now that they're lower here for 4 weeks in a row? How long do you expect that trend to continue? And what do you think the likely range is as we look ahead to 2024?
The mortgage market has pivoted already ahead of the Federal Reserve. So the mortgage rate were 8% just 4 weeks ago, but we have seen 4 straight weeks of mortgage rate decline, now going towards 7.3%. And I believe that this trend will continue such that we will be in the 6% mortgage range in spring of next year. And also the Fed has to remember, there's a little hurt in the commercial real estate. We don't want to have another situation of Silicon Valley Bank. So whether or not the Federal Reserve would want to help the community bank by lowering interest rate, that will be interesting to observe in the coming months.
Now, how is what you're saying in the existing home market juxtaposed against the new homes market as well? Because, I mean, one of the interesting things that we've heard about in earnings calls from companies like KB and like Toll Brothers even is that they're doing this practice of speccing, which is essentially, putting the foundation in on a home, not having a buyer yet, but anticipating that there will be a sale at a future date and that, kind of if you build it, they will come. So, how does that impact then the existing home side?
Well, I'm glad that the home builders are building more homes. In fact, home builders' home sales this year is up 5% from 1 year ago, year to date. So the builders are doing very fine, and they are taking advantage of the fact that lack of inventory. Builders can simply create inventory. Those spec homes, build it. Now, initially, there may be some buyer pullback, but what the builders are finding out is more inventory, more home sales. We're also seeing that on the existing home sales on the upper end. Anything that is priced above $750,000, we have more inventory this year compared to last year, and consequently, we have more home sales. So it's not only mortgage rates, but it's the inventory availability that will determine the direction of home sales. So let's hope that we have more inventory coming onto the market as we go into next year.
When you talk about more inventory coming onto the market, I guess how much of an increase, Lawrence, are you expecting to see?
If we had doubling of the inventory, the market can easily handle that, but we don't anticipate such a big increase. But even at the margin, as the mortgage rate decline, I believe there are many pent-up sellers. That is to say, people who have additional child in the family, looking for better school district. And let's remember, in the past 2 years when the homes were not being listed, there were 50 million job switches across the country, which means that 50 million Americans may be in a wrong commuting direction. So I think they will begin to say, I have to make the next move. I want to list my home and get closer to my job. So I anticipate increase in inventory come next year.
All right, our thanks to National Association of Realtors Chief Economist Lawrence Yun. Thanks.
Thank you.
Keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. We'll be right back.
HP Inc. out with earnings, and well, earnings were in line, revenue down a little bit. Let's really dig into the outlook for the company here. Enrique Lores, CEO of HP Inc. Always great to see you. Thanks for giving us some time here on this. So take us through the quarter a little bit. Inline earnings. I think there were some concerns on the street on how this quarter would pan out. How did you see it?
I think it was a good, solid quarter. We over-delivered versus some of the expectations. We grew EPS 10% year on year. And the most important thing is showed the progress we have made through the year. This was a tough year from a demand perspective. We have managed the business well. We have managed our cost structure. We have grown share, especially in the categories of PCs where we wanted. So really, we finished the year in a strong position, which gives us confidence for fiscal year 24.
Let's look at the sales by segment here. So you look at the personal systems business, PC revenue down 1%, commercial down 11%. Is the worst behind HP in terms of PC demand?
I think it's important to look at sequential sales and sequential revenue. We grew PC sales 5%, company 5% sequentially. We saw growth, sequential growth on consumer PCs, which is what we were expecting. We also saw stabilization in sales on the commercial side quarter over quarter. So second half has been stronger than the first half. And as we shared a few weeks ago, we expect to grow PCs and the overall company in fiscal year 24. And this moment, the results in Q4 supports the momentum that we start seeing.
What's your best approximation, Enrique, on how the holidays might play out? We're getting a lot of mixed reads. On one hand, Best Buy, squishy quarter, some weakness on some of those bigger ticket items, and Abercrombie & Fitch, good quarter from them on apparel that isn't cheap. I mean, how do you see it?
So what we know is we have, based on the shipments we have made and the innovation we have introduced, we have a very strong position in the stores. We have great assortment. And when we look at the projections of 24, we are expecting the market to grow, and Q1 will be the first in which this will start happening. So we expect progress between Q4 and Q1, especially in terms of momentum.
In terms of growth for next year, Enrique, is part of that growth these AI power computers?
Some of it. The key drivers of growth for PCs next year, first of all, is going to be the replacement and the renewal of the install base. driven especially by the transition from Windows 10 to Windows 11. So this will be a major factor. Second factor is going to be an increase of average selling prices, similar to what we have seen during this year. And finally, especially at the end of the year, the impact that some of the AI PCs will start having in the market. But AI PCs will be a great driver of growth in 25 and 26, but because of when we are launching in 24, the impact will be more modest.
So for an investor trying to figure out when these AI PCs launch, because I've heard some other players, some of your competitors talk about them too. Do they launch at the end of calendar 2024 or is it calendar 2025?
They will launch in the middle of 2024, let's say in the July, August timeframe, which is what we shared 2-3 quarters ago when we started to talk about them. But there is a difference between launching and penetration of new categories always takes time. Our projection is that the penetration of AI PCs will be between 40 and 60% 3 years after launch. And they will have an impact on average selling prices between 5 and 10%. And it will happen gradually, some in 24, more in 25, and more in 26.
So this is just my consumer mindset or consumer hat sneaking on me here. How much does an AI PC, how much is that going to cost? And then what will it be able to do?
So let me start from what will you be able to do. What you will be able to do is run locally large language models, which means that if you want to use private data you don't want to upload to the cloud, you can get the power of the language model using your local data. That will be a big advantage. Also for applications where speed, latency is critical, you will be able to run those applications locally. For example, in gaming, many of the new games will use generative AI. You will be able to run the game locally and have the advantage of the speed. And finally, for many customers, there will be a big advantage in cost. Running AI applications in the cloud is fairly expensive. Running them locally will be just the cost of the PC. In terms of pricing, what we have shared is that we expect average selling prices to be between 5 and 10% higher. And this gives you an idea of the additional cost that AI PCs will have. But let me tell you, the value will be much higher than that.
You know, the printer business continues to be under pressure from a top line perspective. Is there any AI potential boost there, or you're just managing this business now, taking cost out of this business and acknowledging that sales will be tough for a little while?
Within the print business, there are multiple segments. There are categories that are declining, like home printing, printers at home. There are categories where we expect the market to be flat, like printing in the office. And there are categories where we expect to see significant growth, like industrial printing. And when we talk about our strategies, we need to differentiate our strategies for the 3 segments. Our expectation is that the print market, because of the combination of these 3 segments, is going to be flattish in the next years. And our goal is to grow profitable dollars in the category by managing the different categories in different ways.
So the sales declines, they're noticeable in the earnings release, but the margins, the operating margins of your business continue to hold up well. We've talked about this a lot. Why is that happening, and can you continue to do this throughout next year?
Well, we launched an aggressive future-ready plan to really address our fixed cost structure, and what we are seeing in our margins are the results of this work. We announced a 3-year plan. We are going to continue to execute that plan. We increase the target that we have, mostly driven by AI and additional actions in several businesses. So we just increased the margin expectations in our print business, and we expect to be within those ranges in the coming years.
As a company that really is going to play a key role in this AI ecosystem, I'm sure you're watching what's happening with the Sam Altman and the Microsoft drama. I mean, as a leader of a company that is going to play in this ecosystem well into the future, do you have concerns on how fast these AI companies are moving with this technology?
I think we are in a time of incredible innovation. And as a company that believes that technology and innovation are going to create a better world, we welcome the speed at which these things are moving. And we have been watching what has been happening during the weekend. Our expectation is that it will not have an impact in the delivery of the new solutions that we need for next year. And again, we are really excited about the opportunities that AI is going to be bringing to us as a company.
You think the tech industry has put in the proper guardrails for this technology? A lot of people barely even know what this is, but it's coming at them, and it seems to be coming at them very quickly.
Well, you know that we really position ourselves as a purpose-driven company, and security and protecting data of our customers is one of our key areas of focus. And we want to make sure that as AI grows, all these data keeps being protected. And this is one of the areas where we are really going to be driving and pushing, because we think it's important that this happens.
Lastly, Enrique, it's the end of the year. We're starting to focus on the year ahead. As a leader, what's the biggest priority for HP looking out into next year? Is it capitalizing on AI? Is it finding more ways to improve costs? Is it improving the supply chain further? Where is your head at?
I mean, we need to work on all these fronts, but if I have to highlight one, it needs to be about continue to bring innovation to the market. AI is one of the elements that we are going to be driving, but when we look at the growth opportunities that we have, we see opportunities to grow by driving innovation in all of them. We are going to continue to innovate in hybrid systems and hybrid work, continue to innovate in our service-oriented businesses, driving contractual, driving subscriptions, and of course, with AI, we can not only create new categories, but improve significantly the experience of our customers in our current businesses.
Welcome to the 2023 Yahoo Finance Invest Asia Conference. I'm Brian Sazi, Yahoo Finance's executive editor. This year, investors continue to face numerous challenges as the economic recovery process proves to be lengthy, with factors such as inflation, geopolitical tensions, and national disputes keeping the global economy on edge. However, in the 2 years since the pandemic end, market goers have continued to see new opportunities and emerging issues. This year, under the theme Beyond Border, Collaborating for Financial Excellence, we will dive into the future economic development of the Asian region. We brought together many top corporate leaders, influential decision makers, and renowned figures to help us dissect how to navigate these challenging times. We will explore how to capitalize on future industry trends like AI, 5G, and fintech amid the rapid evolution of technology. We will also explore how startups can create business opportunities and how to approach a diverse investment strategy in the context of real estate and hot topics like ESG. Now let's get started with the 2023 Yahoo Finance Invest Asia Conference. Welcome to Yahoo Finance Invest Asia, and joining us now is Inalux Chairman and CEO Jim Hung. Mr. Hung, thank you for joining us. I know these are very busy times. We appreciate it.
Hi, morning, Brian. Thanks for having me here.
Take us through the state of your business, making, I believe, LCD panels and displays, really touching consumers not only in your home market, but around the world. What are some of the biggest trends you're seeing right now?
Right. I think overall speaking that LCD TV or panel come out at the very beginning as a device for the digital display images. However, it has been pretty much reached, I won't say the limit, but it's reached some kind of the bottleneck given the demand supplies imbalance. Right now, that what we are seeing a lot of the challenges coming is the price side. However, we do see more value from the panel itself. Actually, not from what we have been seeing on the front. Like people now are looking for bigger size or higher resolution. But we would say that some of conditions we cannot see with the bare eyes include the lower power consumption or effective signal transmission or even the heat dissipation. Those are the things we are actually doing a lot of the investment into. And we believe that our new role as a panel maker behind the screen is like a pivot for the signal and the power transmission. In a nutshell, we are not just a panel maker. We are more as an expert in making the micrometer levels transmission on the glass substrate. So a lot of the new applications like LC window, LC antenna, or even our recent announced investment on the panel level packaging, we believe will put the original panel makers in a very diversified new position.
I was telling you off camera, I recently got an 80+ inch TV, and it has changed my life. But I'm already looking for something bigger. I can't afford it, but I'm already now thinking, what would a 100-inch TV look like in my house? My question to you is, what is next? I can't imagine I'm alone in thinking on, what is beyond the big screen TV? Does it fold? I imagine you have great insight into some of these things.
Right, right. I think like you say that previously people's looking at the TV or the panel itself only just for display the beautiful images, like a beautiful face presenting on the beautiful images. But if you look at the company itself, the companies like Innolux, because right now we are putting a lot of integration into the software. We're talking about the AIoT, for example, that a lot of sensors around the house, around the car. So the application on the panel itself is no longer just on TV. It's no longer just on the monitor or the panel itself. It's actually around the whole world. And that actually put a lot of the new applications into the panel itself. So I do think that it's become a human-machines interface. So that gives a new value to the panel.
How will AI or artificial intelligence change what you do?
Oh, definitely. I think the AI itself is not just a device upgrade. It's actually give a lot of the value to the whole industry. For example, the cycle has been very volatile. Consumer electronics is being up and down significantly. And we do believe that with the AI's help on the market-oriented side, we can be better forecast for the demand and for the hub, for the inventory adjustment. And even if you're looking back into the factory itself, the whole manufacturing process, you know that the panel manufacturing process actually requires dozens of the precise manufacturing from photolithography, liquid crystal spray, so on and so forth, right? So I think with the AI's help, actually that the whole process can be much more efficiently. And also we're talking about ESG. We think that with the AI's help, a lot of the demand can be customized, a lot of the waste during the whole process can be mitigated. So I think that, yes, AI is definitely going to have a significant impact into the whole value chain.
Do you think we'll be interacting with our large screen TVs like we do a tablet?
Yes and no. You mean that how the AI will impact into the TV
Correct.
like we impact into the notebook, right?
Yes, correct. I mean, do you see us going up to our TV because of this new powerful AI and we're touching the screen and we're unlocking all this information that maybe we didn't have before?
Right, right. Yes and no. The reason I'm saying that is because, first of all, the notebook is probably more for the business use. A lot of the applications on the notebook is still for the office, for the education related. So AI on that perspective definitely help the whole process become much more efficiently when we're doing our work, so on and so forth. But TV itself so far was still more for the entertainment. However, from the other side, TV is kind of the center of the whole living room, right? So a lot of people do talk about the possibility that with the AI's help in the TV, in the whole living room, it could become a hub for the whole dining room, living room's control, for the air conditioner, for the washing machine, so on and so forth. Even can connect automatically with the car and other applications.
Just given your worldview, what's demand look like for your televisions and your notebook computers right now?
Right. Okay, I will answer that probably in two folds. First of all, on the global economy, I think obviously inflation and job market, to some extent, the recent rising geopolitical concern, those are the things interrelated with each other and will definitely have some of the concerns to people. And that will probably cap on some of the demands. Even inflation probably reached the peak or almost reached the peak. The impact to the job market is yet to see. So that is something from the overall economy side. However, particularly on the technology itself, I would say that definitely the whole digitalization, or even to an extent, is digital transformation through TV, through notebook, will impact on people's daily life. I think the generative AI is a catalyst, and obviously it will create opportunity and challenge on both sides. So I think flip on the right side, you will overcome the challenge.
As you look into 2024, what's your biggest challenge as a leader and as a company? Just given everything we're seeing in the world right now, these are just very risky times, not only for leaders, but for people on the ground, households, you name it.
Right, right. Like I said earlier, from the very top down, the economic overall definitely impact on the people's pocket, so how much money people can really spend. That will cap on some of the demand side. However, from the other hand, I think the technology itself has been evolved very fast. I think that will be from the company perspective, because each of the business cycle has become shorter and shorter, and that also a lot of abundant liquidity make the whole cycle become very difficult to predict. So the volatility has become bigger, and that's where, as a business owner, that's the difficulty thing, to how to make the business more resilient, how to overcome each of a down cycle. And from my perspective, I would say that actually to break down the silo internally on the organization, and also to have a coherent team is probably the best way to overcome the downturn.
All right, welcome to Yahoo Finance Invest Asia. Joining us now is Acer Chairman and CEO Jason Chen. Mr. Chen, great to have you here at the conference. We greatly appreciate the time. I think so many U.S. investors and consumers know your business through the lens of gaming computers, but let's zoom out here. What is the state of your business right now on a global perspective?
Hi, Brian. It's good to see you, and hi, everyone. Yes, gaming PC is one of the important part of our business, but our business goes beyond just gaming and beyond PC. In fact, we redefine our business scope from PC, from computer to computer science. From computer science, now we push the boundary all the way to lifestyle. So we do have all kinds of different business in different areas, from computer to monitor, from commercial to consumer, and then from hardware to software, cyber security to generative AI accelerator as well.
As we look into next year, what are some of your biggest priorities in terms of driving innovation?
In this area, we keep thinking about it. What are some of the areas that we would like to target and want to focus? And I would say that in 3 areas. Number one is we want to be a good role model of ESG, so environmental protections. We are doing the best we can to use recycled material to embed that into our computer-related product. and home appliance as well. And second level is to make sure that we do enhance our corporate resilience and enhance other companies' corporate resilience, including introducing our cybersecurity service together with building up multiple business engines to enhance the business resilience. The third level is to make sure that we utilize well artificial intelligence into medical and healthcare area.
In terms of AI, we talked to a lot of folks such as yourself in the computing industry, and the vibe is that this will fundamentally change how human beings interact with their computers. What are some of the biggest things that you see happening to the personal computer because of AI?
From personal computer view, I think the biggest thing is the usage model will change from search to ask. So think about that. Today, we use computers and running on a search engine such as Google, try to find the information we need. But they will give you, the search result give you a lot of information that you still have to read through and pull out what you need. In the future, the usage model is going to be, you ask the computer will do it in the background, all the search, and then pull out what you need and compose kind of article or graphic that you need.
Can you get the chips that you need to support where AI is going and how fast it's going to change the computer? I think we look at companies like NVIDIA, they can't make enough chips to supply the innovation we are seeing in this industry.
There are many companies, multiple companies working on AI-related initiative, software, hardware. But most important, I still think, is the usage model change and what usage do people want. So IXIC business is working with tens customers on building up proof of concept on particular projects and specific segments of how to utilize this generative AI technology. And then second thing, people have to decide whether that will be cloud, will be in edge. Then we will decide on which device and what kind of software will be needed. Then at the end of the tail will be what kind of chips will be needed. So it will be a value chain and supply chain change.
As someone that has spent really their entire career in tech, Jason, what's your level of concern that artificial intelligence is moving too fast and there aren't proper guardrails in place?
I don't think so. I disagree with that. I think we still have a lot to do. Artificial intelligence is there for 10 years. The most recent fundamental change is generative AI, and I'm very, very excited about what is happening now, and it can't be fast enough.
Is gaming probably the most exciting area of your business? I think about what video game companies are working on. Microsoft now has, they own Activision Blizzard. I imagine the power of the processors can really change the gaming experience, by extension, what you do at your company.
You are very right. The power of graphic, the power of CPUs, and the power of connectivity chips are all very important, especially the game content itself is taking from 2D to 3D, from a first-person shooting game to strategic games, and we are even working on working with the fashion industry to come up with kind of clothing and equipment that the gamers will appreciate within the game.
What are some of your key products, to the extent you can share, that you're going to launch next year that you think will change the shape of your business?
I think fundamental thing that we can tell you is we have multiple solutions, both on the hardware side as well as on the software side. On the hardware side, from server, AI-based server to AI-based PC computers. From the software side, will be from computer science related AI-based medical image diagnostic and screening tools. Solutions, and then introducing generative AI to multiple sectors, both on public as well as private enterprise.
The demand for computers this year has been challenging, notably in the first half of this year. Consumers certainly bought computers during the pandemic, but now they're back to spending on various experiences such as vacations. Has the PC business, has that bottomed in your view?
Yes, we already saw the bottom, reach the bottom in about May timeframe. Ever since then, the demand has come back to, I call it, the normal seasonality level. And if we compare our demand today, the business today, versus what we have experienced pre-pandemic 2019, now we are actually seeing a bit better than 2019 after the cycle of COVID.
I look at the computers that I use in my life, they just don't seem equipped to handle artificial intelligence. Do you think there's some form of computing super cycle or an upgrade cycle coming so that consumers can unleash the power of AI?
You are very right. Because what happened is the usage model change will stimulate the market demand or the PC demand. The fundamental usage model from search to ask will change, and that will require different level of semiconductor computing power and graphic power, and that will then generate another wave of demand. We firmly believe that, and we are excited about that.
There's a lot of key or just big developments coming at leaders such as yourself, Jason. Geopolitical unrest, fears of global slowdowns. What's your biggest challenge as a leader looking into next year?
Well, uncertainty. We think the uncertainty will come from geopolitical tensions, and now because the geopolitical tensions surpass globalization benefits, then home state economy become the mainstream. And that will restructure the global supply chain that we have to get ready for it.
Given that uncertainty, does that change how you plan for your business? Are you more cautious in how you allocate capital or hire people?
To start with, we don't really have our own manufacturing site. So we use the third-party manufacturing, we call them ODMs or EMS, and we will have to learn more and more to sourcing, working with a local supplier other than just a global supplier at this moment.
Are you still a believer in globalization?
Not as much as I did before. I think the globalization will gradually move into home state economy, and that's an evolving process, and it's happen quickly.
Welcome to Yahoo Finance Invest Asia. Of course, many investors around the world look to what's happening in the telecom industry and key emerging markets for really clues on what's hot in technology and what is hot or not in various emerging market economies. Let's bring in Taiwan Mobile President Jamie Lin, because I think he offers just a really great snapshot into a lot of these key trends. Mr. Lin, thank you for joining us.
Thank you, Brian. It's my honor to be here.
So talk to us about the state of your business. What are some of the top trends you're seeing right now?
In terms of the telecom industry, of course, 5G is sort of the growth driver for the industry over the past couple of years, and it's looking to continue to provide tailwind for the industry over the next at least 2-3 years. In terms of our e-commerce business, our Momo business, post-pandemic, people's purchasing behavior has been changing. So we're sort of transforming our business to stay ahead of the game. In terms of the accelerator business efforts that we're running, ever since sort of the global macro market stepped into this sort of bear market cycle, we're seeing less wise called tourist founders and more founders are determined to build the next generation impactful big companies. So those are the trends that we're seeing in the market right now.
I absolutely want to dive deep into the startup comments you just mentioned, because I know that is a topic very near and dear to your heart. But on the telecom side, in terms of 5G, where is your company at in terms of that rollout of 5G? And what is next? You know, as a leader of your company, is there a 6G? What does a 6G even look like?
So 5G, we have since rolled out the service nationwide. So the coverage is more than 90% at this point. Conversion is around 1/3. So 1/3 of all of our subscribers are now using 5G. When they're using 5G, they're sort of using 5G for close to 50% of their data usage. So 5G is really not unlike 4G, which is everybody came onto the technology within a matter of a few years. We see 5G more as a steady conversion over time. So that's why I said we're expecting this trend to continue at least for another 2-3 years. In terms of 6G, right now I think it's very early, still very early in the game. The industry as a whole is still defining what 6G really is. Some say it is satellite, some say it is faster land-based base stations. I think it's still up in the air. So I think it will take another 2-3 years before all of us together decide what 6G really is.
Is the iPhone, the Apple iPhone, is that still the dominant phone where you play? And what other phones do you see consumers gravitating towards? And is it just a price-driven market at this point?
So in Taiwan, there's essentially two markets, right? So iPhone occupies around 1/3 of the market. And for those consumers, they're that loyal to iPhone. So sort of every few years, they would upgrade to a newer version of the iPhone. And the churn rate from iPhone to other operating system is super low, single digit. The rest of the market, the rest 2/3 of the market is Android users. And they do switch back and forth between different Android brands. So for the iPhone users, they really don't care about the prices. Whereas the Android users, you do have segments. So you do have people who are looking for a better deal, and you do have people who are going for the Samsung, the Pixel of the world that is more premium priced.
With the new iPhones hitting the market, Jamie, have you been pleased with the consumer response so far?
It's been doing very well for us. So we're seeing 20% YOY growth so far after the iPhone 15 launch.
Wow, that's pretty big. You know, I think U.S. investors see the economy in Taiwan. It's still growing, but it has slowed. How has that impacted your business?
So in terms of telecom, I think it's still a must-have, right? So at the end of the day, people still pay their telecom bills. Our 5G all-you-can-eat rate plan is around $40 per month. So it's cheap enough for most people to afford. So right now, I think price is still not a huge factor in terms of considering if they want to use the 5G service or not. It's more if they need that type of data service. In terms of our e-commerce business, Momo business, like I said, post-pandemic, people's purchasing behavior is changing. So we are implementing transformation strategies to stay ahead of the game.
Do you see AI transforming the telecom industry? And if so, how?
Right now, I think AI has a lot of applications in telecom and in most of other industries that we're observing. So
sort of most impactful applications would be in customer service, internal sort of knowledge management, and so far and so on. In terms of greatly transforming the telecom business, I think we're sort of, based on our observation, maybe some decentralized type of business model based on blockchain or based on Web3 might be something that would truly transforming telecom instead of AI.
Do you have to set up new safeguards and new technology to protect consumers?
Oh yeah, so when you're implementing AI, we all know that its biggest problem right now has all of these hallucination problems, right? So yes, so when you're implementing AI, you have to fine tune it, you have to put on a lot of guardrails to make sure that, especially when it comes to consumer-facing applications, you have to put on a lot of guardrails to make sure that it doesn't say things that goes against your core beliefs. But we're also hopeful, because if you look at the newest version of BART, which is Google's large language model, now it has the ability to cross-checking with Google search, meaning that it can actually, through working with Google search, double checking if what it's saying is right or not. Right now, it takes a few clicks for you to fact check it, but I think pretty soon Google is gonna make the process automated. So we're actually hopeful the hallucination problem might be solved in the next 6 to 12 months.
Welcome to Yahoo Finance. It is noon on the East Coast, 9 a.m. on the West. I'm Akiko Fujita along with Rochelle Akufo. Here's what we're watching at this hour. Holiday shopping in full swing on this Black Friday as retailers are hopeful but cautious on the strength of the consumer. We're going to be getting a first-hand look of the in-person shopping action in the show.
Meanwhile, Amazon has its hands full this Black Friday. The e-commerce giant testing a new strategy with the help of the NFL. Prime Video exclusively streaming the first ever NFL Black Friday football game, while Amazon also faces warehouse workers striking across Europe in protest of the company's working practices.
And looking ahead to 2024, we're going to be going through how you can prepare your budget for the new year. But first, let's take a look at the major indices on this shortened trading day. It's a light trading day, usually the day after Thanksgiving. We've got the Dow up about 60 points there. The S&P 500 down slightly, as is the Nasdaq. We should point out the Dow now on track to post its longest win streak since April of this year. We are keeping a close watch on retailers as we really kick off the busiest shopping season of the year. All in the green right now, though not necessarily an indication of where shopping could be headed in the holiday season. And worth noting, Bitcoin hitting its highest level this year. Take a look at where it's trading right now, well above that $37,000 handle, up about 1.7% there. We're continuing to see sort of the trickle of the implications of CZ Changpeng Zhao agreeing to plead guilty to criminal charges by DOJ. So some of that overhang being lifted here as Bitcoin continues to push higher.
Indeed, and also taking a look at what we're seeing with the Treasury market as well, ticking back up. You see the 5-year, the shortest, up there almost 1.5% on the day. A strong showing also for the 10-year, currently at 4.48, up 1.5% on the day, and the 30-year also up 1.4%. So still some room to run here for these Treasury yields so far. Well, let's turn now to Yahoo Finance's Jared Blickery with a closer look at all this market action on a relatively low volume trading day. Jared.
Yes, Rochelle, I think most investors do not want to see fireworks today, and that's not what we're seeing right now. Russell 2000 leading the pack in the U.S., that's up 0.5%. Just want to show you what's happened for this 4-day trading week, skipping Thursday, of course. Over this period, Looks like IWM, that is Russell 2000 ETF, up 0.5%. Nasdaq up about 83 basis points, so a little bit less than 1%. And the Dow is leading, that's up 1.15%. And you were just taking a look at the bond market. Just want to give a little bit of a bigger picture view. We have been heading south, that is lower in yields for several sessions, but then we have jumped back up 7 basis points. That is the highest, that is the biggest jump that we've seen in about a week. Nothing big, but I think it's notable that we're still sticking below 4.5%. The trend, importantly, has been down, notwithstanding the little bump that we're getting today. So let's take a look at some of the sector action. Really interesting month so far, but I'm going to take a look at the week to date after I take a look at what's happening today. Energy up 0.7%, followed by materials. But let's take a 4-day look, and you can see healthcare and staples. Those are the two leading sectors. In as much as they are defensive sectors, you might think, well, is this a defensive market? I'm going to show you the month to date, and this is just screaming bullish right here. Tech, that's XLK up 12%, consumer discretionary up over 10%, real estate, and then communication services up 9.5%. You take a look at that Nasdaq 100. This is what's happened in the month of November. A lot of outperformance by these mega caps that have just carried the water for the entire market all year long. But let's take a look at what's happening this week, and we can see NVIDIA taking a little bit of a backseat. We did recently have those earnings we've been talking about, but for the most part, not seeing a lot of outsized movement. I'm just going to concentrate on what we're seeing today, and let's take a look at the Dow. I haven't taken a look at that yet today. And we can see, aside from these big tech names, mostly green here. We're seeing Nike, IBM, Boeing, McDonald's down just less than 0.5% there for all of those, and also not seeing too much in the way of a lot of movement here. Finally, want to take a look at meme stocks and just show you, it's a mixed board today, but take a look at what they've been doing in November. We've seen this incredible rally. I was talking about the mega caps carrying the water, but guess what? Lots of other markets are getting dragged along, and I think a lot of people who are still underwater in these securities from several years ago might be hoping for some kind of a comeback here. Is it going to get back to break even? Let's take a look at Coinbase. That's very heavily tied to the price of Bitcoin, but you can see still down two thirds from its mark at the beginning of or whenever it IPO'd in 2021. So a lot of these issues still have a long ways to go. But as we've been seeing here, and let's take a look at EVs in November, lots of investor excitement because a lot of these issues just haven't seen too much of a spark this year, guys.
All right, Jared Blickery with a breakdown for us on this holiday weekend. Thanks so much. Well, it is Black Friday, a big Super Bowl for our very own Brian Sazi, who took a trip to the mall along with a few others early this morning to give us the vibe on the ground. Take a look.
Brian Sazi, Yahoo Finance here at Roosevelt Field Mall in Long Island, New York. Black Friday is underway. Sorta. You can see some of the crowds here. I would kind of call it a crowd, nonetheless. There are human beings here at Roosevelt Field Mall to kick off. It has traditionally been the start of the holiday shopping season. Of course, crowd's a little sparse. Everybody's still trying to get over Thanksgiving, and they're also buying things online. So as you can see, people are, in fact, here. Usually the crowds build throughout on Black Friday. I suspect that will actually happen again. But if you're an investor and you're seeing Black Friday, you're seeing all the excitement around it, you're seeing the stocks move during the session, here's the biggest risk to a lot of those retailers trading and the tickers you see on the Yahoo Finance platform. The biggest Black Friday risk you need to consider is that discounts are expected to be up year over year. Right now, according to Salesforce, the latest data I have from the Salesforce team, the average online discount is 26%. That's up really from about 25% last year. So again, higher discounts year over year. You go back to the Adobe data that was reported a couple weeks ago ahead of Black Friday. The average discount this holiday season is expected to be about 35%. That's up versus, I would say, 25% last year. So, of course, consumers concerned about the state of the economy. Yes, gas prices are coming down, but you have the return of student loan payments. Inflation is still high, so retailers are really, a lot of those retailers, as you can see behind me, they're looking to get the consumers into their stores as quickly as possible, and they're offering bigger discounts year over year. Now, the biggest risk here, in fact, is that those discounts impact profit margins for retailers. That is more discounts hurts margins, maybe profits. So as you're watching these retail stocks, keep in mind, amidst all the excitement, there are risks out there, notably cautious consumer, higher discounts, and maybe the fourth quarter holiday shopping season won't be that merry for a lot of retailers. That's Brian Sazzi, Yahoo Finance. We'll talk to you soon.
Our very own Brian Sazzi there, scoping out the mall early for us on this Black Friday. I can sense the excitement, Rochelle, when Brian Sazzi goes through the mall here. But look, early numbers out from Adobe Analytics pointing to a slight bump that we have seen in spending during the holiday. Online spending was up about 5.5% on Thanksgiving Day. The National Retail Federation says consumers are expected to shop more than ever during this holiday weekend, but retailers, including Target, Walmart, and Best Buy, have all voiced some caution over the health of the consumer this holiday season. Brian just pointing to some of the key concerns that are out there. But Rochelle, we've been talking about this throughout the earnings season, right? When you think about what we've heard from the Walmart CFO saying sales have been somewhat uneven. Williams-Sonoma saying the retailer sees consumers sort of showing ongoing hesitancy. And then you've got those like Target executives saying that consumers are asking when they pick up something, is this going to add value to my life? How does that all translate into sales during the holiday season? That's still a big question mark.
It's true. And we have to remember, we also have that, what we saw from the pandemic. So I'm looking at companies like Home Depot, some of these ones that had breakneck sales, obviously, during that. But then even when they reported earnings, still noting some caution, saying the CFO is saying that this is a period of moderation, even when it comes to home improvement. A customer who would have remodeled their entire house instead maybe is saying, let me just do my countertop, let me just do my sink. So everyone's having to make some very tough choices at the moment. I did think it was interesting that for companies like The Real, because on Sunday you have Giving Sunday, but you also have Secondhand Sunday for people who want to do secondhand shopping, a little more, you're worried about sustainability. They're actually doing very, very well. A lot of people sort of pulling back on that top tagline for some of these luxury goods, but willing to spend for something they can invest in, perhaps a piece that's a little bit cheaper, but they can hold on to it. But I think a lot more discerning consumers this season, picking out, being very specific about what they want, looking ahead to, Christmas and holiday shopping. But if I don't need it, for me, I'm not buying it or I'm stacking my discounts.
Yeah, Rochelle, the other thing I think, worth watching is how consumers are going to pay for these purchases. We've been talking about an increase in credit card delinquencies. You had the data coming out from the New York Fed recently pointing to that number. You see at the very tail end of that chart starting to tick up again. The data there pointing to household debt balances increasing $228 billion, credit card balances up $48 billion. And then this number that I think is kind of interesting from Adobe Analytics, buy now, pay later purchases, climbing about 6% over the same period last year. So there's the spending part, and then there's how they're spending it and what comes in January when those bills add up.
Indeed. I mean, you raise a good point there. People, as we saw from Rick Newman, he was reporting on it this week, saying a lot of people down on the economy, you're not sure about where it's going, but still spending, still putting things on credit cards. So something we'll continue to track. Well, weaker guidance this holiday season isn't the only headwind on investors' minds. Our next guest says the Fed risks pushing back too hard on rate expectations. Here to discuss is Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Thank you for joining us this afternoon. So in terms of what we're seeing from the Fed risking breaking something, because even markets predicting perhaps a little bit too early some of these rate cuts that they're expecting by perhaps June of next year. What do you think people should have top of mind when they think of how the Fed is moving in this period, because they've been pretty consistent?
Yeah, I think that one of the things that we've heard from the Fed lately, from the Federal Reserve's minutes, was that it was unanimous that they should proceed carefully, which is a nice change from proceeding recklessly with a lot of the rate hikes. I think that when we see the 10-year Treasury yield below 4.5%, that makes me a little bit nervous that the Fed might change their messaging, because when we were between 4.5% and 5% on the 10-year Treasury, they seemed to actually kind of like that range because financial conditions were tightening, and they thought that the market was doing the Fed's job for it. Now that we're below 4.5%, I think we run the risk of that change in narrative where the Fed might push back on those expectations. Their next meeting is December 13th. I don't think they're going to hike, but I think Chair Powell, when he comes out to speak next week, he might try to open that door again. And that could be a little unsettling for investors as we approach especially the Christmas season.
Brian, as we watch where yields have been trading there, is it about where the rate is or how quickly it has jumped up? I mean, that's one of the things that we saw in between the more recent Fed meetings about sort of the market doing the work for the Fed, but we've seen just as quickly some of those yields pull back.
Well, that's a very good point. And actually, a lot of the evidence suggests that it's not the level of the yields so much as the rate of change of those yields. That's really evident in the housing market. If you find some stability with mortgage rates, pretty much at no matter what level, people can then adapt and adjust to that. When you think that you have a lot of volatility, rates might go up, they might come down, that's what gives people pause. And I think that something similar happens to businesses with investment spending. I've been talking to a lot of business owners, and they just want a little bit of stability with the rates so that can aid them in their long-term planning. When they're sitting there thinking that, well, if I wait 3 months, are rates going to be significantly lower? Or they're going to be significantly higher? That type of uncertainty really just puts them on pause when it comes to capital spending plans.
And so even when you look at the consumer themselves, obviously we've been tracking a lot of consumer behavior here. Going into the holidays, still continuing to see that caution in a lot of these earnings calls. Who do you think is better positioned when you look at some of the companies out there, some of these ones with, having to push promotions, especially to try, and then you look at what's happening with their margins. Who do you think is better positioned at the moment?
The way that we're positioning things here at Annex on our investment committee is to really look at it company by company. And if you kind of compare and contrast the market reaction to, say, what happens with Dick's Sporting Goods when they were giving good guidance for the holiday season versus somebody like Best Buy or Kohl's who are giving negative guidance. What we kind of like to see in that is if you see an outsized reaction to the downside, then dig in and explore what are their margins actually like, because you were talking about Target earlier. Target is a good example of a company that last year, they were really struggling with inventory management, the idea they were going to have to do deep discounting, but then they surprised by having actually their margins expand. And so we actually think that there are some good opportunities in the consumer staples and discretionary area. So within retail broadly, for those companies that have already gone through some of these growing or adjustment pains.
What are some of those names?
Yeah, unfortunately, I can't talk about specific names as far as within client portfolios, but in terms of the general themes, a lot of people were really focused on leisure and hospitality as being the winners. Now it is likely shifting more towards those with that diversified mix of goods, maybe some of the groceries, some of the clothing, household goods, areas like that. So more of that broader spectrum where consumers, no matter what their financial condition, are they going out shopping for others or are they going out shopping for themselves? So those that have that mix are probably going to ride through this. You can probably figure out what some of those names are.
Okay, we'll likely get a better gauge after the end of this weekend. Brian Jacobson, as always, good to have you on. Appreciate the time. All your markets action ahead. Stay tuned. You are watching Yahoo Finance. Well, on Thanksgiving Day, we saw homes across the U.S., millions of Americans telling each other what they're grateful for as they ate their body weight in turkey and gravy. Was certainly one of them. Well, today sports fans are grateful for one thing in particular: Black Friday football. Amazon Prime, the gatekeeper, as the Jets take on the Dolphins. The Dolphins are really all-out favorites here, but fans will be tucking into all sorts of snacks and beverages at MetLife Stadium. But your favorite foot-long hot dog doesn't get there by magic or pixie dust, Rochelle.
Indeed. So enter Sodexo Live. The company operates the food and beverages at top stadiums around the country. And this includes many games being played this weekend, like the Big House for the mega grudge match between the Michigan Wolverines and Ohio State Buckeyes, and Lucas Stadium of the Indianapolis Colts. But what does it take to feed tens of thousands of hungry sports fans? Joining us now, Belinda Oakley, North America CEO of Sodexo Live. Thank you for joining us today. So break this down for us in terms of your best-selling items that you're expecting for an NFL game like this one.
So I think we continue to see the old fan favorites, right? No one is going to miss a hot dog at the ballpark or a burger at the stadium. But I think what we see from fans today is they're demanding next level experiences, whether it is today
Well, at homes across the country yesterday, millions of Americans told each other what they are grateful for as they ate their body weight in turkey and gravy. Today, sports fans are grateful for one thing in particular, and that is Black Friday football. Amazon Prime, the gatekeeper, with the Jets taking on the Dolphins. The Dolphins are all-out favorites. Even so, fans will be tucking into all sorts of snacks and beverages at MetLife Stadium. But your favorite foot-long hot dog doesn't get there by magic or pixie dust. Rochelle.
That's right. Enter Sodexo Live. The company operates the food and beverages at top stadiums around the country. Now, this includes many games being played this weekend, like the Big House for the mega grudge match between the Michigan Wolverines and Ohio State Buckeyes, and Lucas Stadium of the Indianapolis Colts. But what does it take to feed tens of thousands of hungry sports fans? Joining us now, Belinda Oakley, North America CEO of Sodexo Live. Thank you for joining us today. So give people an overview here in terms of the cost that goes into feeding an NFL crowd for an event like this.
Yeah, look, it is, as you said, it's not getting there by magic, but it certainly takes a little pixie dust, I'll tell you that. We have about 20,000 associates around the country, and on a game day, that might be 1,000 people in one of our stadium environments. And as you can imagine, these aren't easy stadiums to navigate, especially when you put 70,000 people in there. So we have a very talented team of chefs, bartenders, operators, who really start prepping for the next game at the end of the last game. So it's certainly a bit of magic indeed.
Belinda, how have you had to navigate some of these price increases? We've been talking so much about sort of inflated prices out there. I will tell you, I was at a college football game last week, paid $35 for a burrito. That tells me where things are right now. But talk to me about how you've been sort of balancing all that, just considering the complexity of the operation.
Absolutely. And I think consumers see it in their day-to-day life. We are obviously seeing deflation. We are close to 3.7% now on CPIU, which makes a huge difference to the overall pressure. But with the lower labor, the tighter labor market, and an unemployment rate sub 4%, a lot of people moving out of the hospitality business in the great upgrade, as they called it, we would beg to differ. We think hospitality is still one of the best industries to be in, but it does create a tremendous amount of pressure. I think the way we're seeing a lot of our business, and particularly for Sodexo Live, the way we're countering it is making sure that we have a variety of pricing and menus so that everybody can get what they need. We see people really wanting to dial up their experience with Wagyu burgers, or the joke of champagne and caviar is alive and well. However, the family-friendly pricing still has to be there, whether that's on pretzels, hot dogs, burgers, and that just takes a little creativity. It takes working with, obviously, items like chicken right now versus beef, as we see beef still continuing to climb, and just being a bit more creative on menu engineering and range of items available for people. And that's what Sodexo Live is here for.
And Belinda, to that point, you've added some value items to your menus. Also noticed that you've added more locally sourced vendors as well. Talk about that dynamic, especially when you think of the reach that Sodexo has. How are you working with some of these local vendors?
Well, I think the best part about being able to work with local is that not only does that give us the local flair, because I think when you're in Miami, you want to feel you're in Miami. When you're in Indianapolis, you want sweet tea fried chicken. So for us, being able to work with local allows us to keep it local feeling, but also that opens up for great women minority-owned businesses to be a part of our global supply chain. We're about $20 billion worth of supply chain purchases a year here in the US, which makes a huge difference for not only our buying power, but that can really be an incredible start for a local restaurateur or operator to be able to take advantage of our scale and us help be a foot up for them in the industry.
Belinda, this summer we've been talking a lot about the success of Taylor Swift as well as Beyonce, these concerts, consumers really wanting to get out and experience something. At the same time, though, we have learned increasingly that there's a limited amount of money, right, that they have to work with. I wonder what you're seeing in some of the stadiums you work with about a consumer's willingness to spend at an event. How have you seen that change up?
Yeah, absolutely. And it's funny you mentioned Taylor. If it's not a day ending in Y, we're not being asked about our Taylor Swift shows. We have a number next year. So it's certainly the event on everybody's tongue. I think what's very interesting, and we're seeing it in our venues, revenues are up close to 7-8%. But interestingly, it's not about the cost of the average transaction that's driving that. It's actually about the number of transactions. It's people wanting to take advantage of more experientially while they're in a venue or an event. So they're going more often. Now, autonomous styles of service are helping to drive that throughput as people are able to get a break, go and get either an amazing lavender haze cocktail or pick up something from the snack bar and still get back to their seats without missing the show. So we aren't seeing this slow in average spend. What we are seeing is an increase in number of visits to a food or beverage outlet while at a venue. I think, to your point, what will we continue to see in terms of the fan experience? We continue to see the emphasis on live events being more towards the older population, and we're seeing Gen Z and millennials still preferring 58% saying their live experience is important to them versus the rest of consumers about 71%. So the pressure continues to be on to figure out what is it that next generation is going to want from their experience, and is that economy? We're not seeing it, I would say, from our college fans at our college sports experiences. They are still spending and certainly not showing any signs of slowing.
And Belinda, just very quickly, who tends to be the biggest spender? Some of these one-off incredible concert attendees, or the people who are sort of your tried and true football fans who are showing up week in, week out?
Great question. Look, I think what we see for our sports fans, our real fandoms who spend most of their time at the game, they're obviously making choices on a weekly basis to be economical, but we still see that, especially when the results are up, we see a huge difference in per cap spend. So it kind of depends how the team is playing, I would say, in terms of who is spending the most. But obviously something like these key concerts, whether it's a Super Bowl that we're fortunate to have in 2025, or whether it's any of Taylor's shows, these are once in a lifetime experiences, and people are certainly not watching their budget while they're there. They're enjoying every element of the experience to the best of their ability.
That is definitely true. As someone who went to the Beyonce concert, I don't even think I looked when I was swiping my card for that cocktail. Appreciate you joining us. Belinda Oakley, Sodexo Live North America CEO. Thanks so much and have a great weekend.
Thanks so much. Enjoy the game today.
Thank you. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Well, shares of iRobot are on the rise, with Reuters reporting the European Commission will greenlight Amazon's $1.4 billion bid to buy the company. The deal is on track for unconditional EU approval. For more, let's turn to Yahoo Finance's Dan Halley, who's been tracking this for us. Dan, what does this ultimately mean in terms of the timeline for this being completed?
Yeah, Kiko, I think the only thing we're really looking for is the FTC to kind of sign off on this. And, you know, as far as Amazon goes, they are obviously facing a lot of issues when it comes to the FTC itself, but you know, antitrust issues around the world when it comes to different regulators. And so to see the EU sign on off on this unconditionally bodes well for the deal to kind of be completed and for the FTC to agree to it as well. You know, the EU is one of the stricter antitrust authorities out there. And so the fact that they're allowing this seems as though, you know, it paves the way for Amazon to officially take over iRobot. And so, you know, I think overall, this is generally a good move for Amazon itself. It's not about the robots, really. It's about what kind of data that they can collect by using robots. And so they would allow people to, you know, with consent, get a better look into consumers' homes, the layouts, things that they may need to do to develop new products for their Alexa line. So this is going to be a big move for them. How much, though, kind of is up in the air. We know that there's been cuts to the Alexa division. There's reshuffling around product announcements and product lines. So we'll just have to wait and see to find out more.
Well, big thank you there to Dan Howley and his beautiful cat as well, who made a special appearance. Appreciate you as always, our very own Dan Howley. Well, taking a look at NVIDIA shares, they took a dip after reportedly delaying their new AI chip for China, despite being designed to comply with US export restrictions. Sources told Reuters that the delay was due to issues that server manufacturers were having in integrating the chip. For more on what this means for NVIDIA stock, we turn to Constellation Research founder and principal analyst Ray Wang. Ray, always good to see you. So give us your take on this situation, because we knew some companies were going to try and find a workaround for the chip restrictions put on by the Biden administration. What does this mean for NVIDIA?
Yeah, I think it's important to realize it's not easy to get a chip out there. It's not easy to get a chip certified. And so what NVIDIA is trying to do with the H20 chip to get out into China, it's going to take time. And it's not going to be just them. It's going to be everyone else. But it leaves an opening for Huawei to jump into that market. And that's what investors are reacting to. But I think the flip side of this is that it's not easy getting a GPU or chip out the door. So all those people who think that NVIDIA is going to have competition right out the back, whether it's coming from AMD, whether it's coming from Microsoft in the future or Google's TPUs or anybody else, it's not that easy to get a chip out the door. So if it takes NVIDIA a little hiccup to get this out the door, it's going to be just as hard for someone to come into the market.
NVIDIA, Ray, certainly one of those names that is more exposed to the Chinese market. About a fifth of their revenue comes from there. In this particular case, though, you mentioned Huawei. Do they have the tech to match what NVIDIA would have offered here? I mean, these are chips that the company was building specifically for the Chinese market for the workaround, the export controls.
You're definitely right. It's not easy to do that. Does Huawei have the chips? The short answer is no at this moment. But keep in mind, like, you're taking a Rolls-Royce to solve an AI problem. Maybe they'll just use a few more Huawei chips, which would be the equivalent of getting a Ford or GM chip out there. And I think that's the important thing, is like, you don't always have to use the high-end chips to get to the answer. And you might have some workarounds along the way. And I think that's what China is going to be doing, especially with the export ban and the trade wars that are continuing.
And what are we seeing in terms of demand, especially for these advanced AI chips, and whether or not NVIDIA is able to keep up with some of the demand as people essentially are still gravitating towards NVIDIA over the competitors?
They are definitely keeping up with demand, right? If you look at the revenue in the data center, right, it's up 41% from Q2, but you got to take the year view and it's up 279%, right? Data center revenue blew everyone's expectations. That's 14.51 billion. And that means every public cloud vendor is basically refreshing their data centers, making sure they have the chips that are going to solve the AI problem. And if you look deeper into the numbers, you realize the public cloud providers were half the revenue of that data center business. So definitely they're keeping up with demand, and definitely the demand is still there.
Ray, specifically on the China exposure, though, how do you think investors should be looking at this moving forward? I mean, this is just one case, but as we've seen, this is one of those companies, along with an Intel, that kind of gets wrapped up in U.S.-China geopolitical issues. So is this sort of NVIDIA sort of can increasingly make up ground in other markets? I mean, should investors be sort of betting on this revenue continuing to come through from the Chinese market when you consider where policy is headed?
You're definitely right. I think the way to look at all tech policy with China is China was on a mission to basically replace U.S. technology. They created joint partnerships. The partnerships were really technology transfer exercises. You make a little bit money in China, but you lose the whole business and your IP in the long run. I think every tech vendor has faced that challenge. Investors should just brace for the fact that in the long run, the China business is really not a business to be in. It's a business that is an exposure risk. Once you understand that, then it's how do you make up the revenue in other areas, and you have such a lead on the technology that you're still in demand, and China can't commoditize that technology. We saw that with solar panels, we saw that with PCs, we saw it with networking gear, we're seeing it in pharmaceuticals and other areas. We just have to be careful of that from a geopolitical risk.
So then, Ray, if not China, then who would be a solid alternative, or given how far ahead China is, especially though, in terms of not just the technology, but the ability to manufacture it as well?
So I think NVIDIA has at least a 3 to 5 year lead here. And a lot of it's really in chip design. There's a lot of export controls, and it's a lot of the know-how in getting these chips to work. That's not something that's going to be easily copied, but you can slow it down. It doesn't mean you're going to, forever be able to keep China from being a competitor. That's just not a reality. The demand is really going to come with more advancements on the AI chips. With chips, it's always about being faster, cheaper, using less power. Those are the things that people are looking for. As we get to 2 nanometer technologies and even smaller, those are going to be things that you're going to see that the advancements are still on the US side, but that might be a lead for just this decade. And that's an important thing to realize. The other demand has really come from new types of chips, and new types of materials and material science that's going to change the way chip design occurs in the future. And so I think that's where people have to actually focus on. But for the next 4 to 8 quarters, I think NVIDIA is in good shape. There's still a lot of demand, a lot of AI use that's going on. And of course, the data center companies are the public cloud vendors are basically in their refresh mode.
Ray Wong with Constellation Research. Good to talk to you today. Belated happy Thanksgiving.
Take care. You too.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
With 2024 approaching, people are thinking about their finances and retirement going into the new year. For more insight on how to stay on top of your own fiscal responsibility, we turn to Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal. Good to have you back on the show. So, give us some context here, because a lot of people are so focused on, getting through this holiday shopping season. They're not ready to start thinking about budgeting for next year. What should people keep in mind right now as they're keeping in mind what they could be preparing for in 2024?
Sure. Happy holidays, Rochelle. It's a pleasure to be here. And, this is a great time. We have time with family and friends, and we have some downtime when things slow down a little bit. So it presents a great opportunity to take a look at some things. First and foremost, take a look at your budget for 2023. How did that work out? Were you ahead, behind? Use it as a gauge to then start planning your 2024 budget to see if you could stay within those same parameters or perhaps increase it a bit. And remember, include some joy into that budget planning. It's not all about saving for retirement and for the future. It's also about enjoying today. Take a look at your emergency fund. Is that something that you've depleted or needed to tap into over the past year? And if so, have a game plan to start replenishing that. And I think from a retirement planning standpoint, it's a great opportunity to take a look. Many times we see people failing with regard to their retirement plan in terms of not contributing enough to take advantage of their full employer match. This is free money. There aren't many times that you can get free money, and this is an opportunity to make sure that you're putting away enough to at least get that full match by your employer.
Lawrence, one way to get off on the wrong foot for the new year is to get a massive credit card bill coming through from the holidays. And we've been talking a lot today about consumers having to stretch a bit more this holiday season. As we see them go out to buy things over the weekend, over the next few weeks, how do you think they should be budgeting how much they can spend?
Well, hopefully they've had that budget already and have that in place. But if not, they should be taking a look at what they do have to budget, perhaps for these holiday purchases. And I think it's important and really vital. And I don't want to stop the consumerism that we're seeing in this country. But at the same time, we have to be careful. Be careful about making purchases on credit cards, for example, that you cannot pay off at the end of the month, because it's not just the cost of that purchase then, it's the cost of the purchase plus interest and how long is that going to take you to pay off? It could end up, being 50 to 100% more, depending on how long it takes you to pay off that debt. So be very careful. Most importantly, try to only spend things on the credit card that you can essentially pay off at the end of the month. And then if you're looking for yourself, avoid impulse buys. If it's something you're thinking about purchasing or you want to, and it was something that was new and brought to your attention, maybe take 24 to 48 hours and see how you're feeling about that, because you may have a difference of opinion. And I think lastly, being today Black Friday, there are a lot of deals out there, but the question is it really a deal? You have to do your homework and know if you are or you are not getting a deal. And it's important to do more homework on some of those larger purchases.
It's true, because when I'm shopping, I always think saying yes to this means saying no to something else. If I buy something expensive, then that means no to something I could have invested, that would have actually brought me some returns. But as people sort of look ahead, they're looking at their 2023 tax filings, perhaps. What should they be prepping for, considering any of the changes that we've seen this year?
So, many of that stuff, many of the things that they could possibly do, our viewers here, we only have a few weeks left to do them. So number one is start getting prepared for those tax returns, maybe start putting together a file for those important documents. Take a look at your 401k. Perhaps if you haven't maxed out, there are still a few more pay periods, or if you haven't put in enough money, there's still a few more pay periods if your employer will allow it to increase that to lower potentially your tax deduction, if you will. If you have other expenses or charitable deductions that you're looking to take, perhaps early next year, it may pay for you to take advantage of them now before the end of the year and push that tax deduction to 2023, where it may be more impactful than it would be in 2024.
Lawrence, as you sort of advise clients right now, we're talking about Americans increasingly turning cautious. Are you finding that they're a little more alert, about some of these savings they can make in 2024? What are you hearing about how they're thinking about their finances going into next year with all of this uncertainty in the economy?
I think for the most part, people are cautiously optimistic. For the most part, we're an optimistic society, and people feel that what we're seeing today will not necessarily be around in the same fashion it is today. It may be different, maybe less so, but we feel the conversations we're having are much around optimism and feeling that we are far better off where we are today than we were a year and a half ago. A lot more certainty. We were in a much more uncertain environment a year and a half ago. So I think that certainty is adding some stability. I think this holiday season may be a little impacted because some of that stability has just come back into the markets, and I think people's mindsets recently. But I think going into the new year, that should continue in a big way.
Okay, Lawrence Sprung, some good takeaways there as we look ahead to the new year. Thanks so much for joining us today.
Thank you very much.
Well, the closing bell coming through on Wall Street as we round out a shortened holiday trading day today. Santa Claus there making his appearance at the New York Stock Exchange. And of course, all eyes on the holiday here as everybody looks ahead to go out and shop, spend. Question is, how much will they actually spend? Retailers certainly in focus today, but let's take a look at where the majors ended. The Dow up 117 points, the S&P 500 trading flat, and the Nasdaq just below the flat line there. The Dow now, by the way, posting its longest win streak since April of this year. So rounding out a shortened trading week on a positive note there. Taking a look at some of the other retailer names we've been watching today, that certainly in focus on the back of the kickoff of Black Friday as well. And by the way, we should point out Bitcoin hitting its highest level this year. We did see it was above. There's the retailers we were watching for. You see green arrows across the board there, but we're going to continue to see where those numbers came in. The big verdict's going to be on the back of Cyber Monday to take a look at where consumers are right now. Well, Amazon streaming its first ever Black Friday NFL game between the New York Jets and the Miami Dolphins today on Prime Video. This comes as cable continues to struggle with slumping ad revenue and cord cutting. For more on what this means for traditional TV and live sports, let's bring in Yahoo finance reporter Ali Cannell. Ali, I want to know more about what this means from a viewing experience. I mean, we're watching football. We're probably going to get some signs of a deal on Amazon. Seems a little distracting, right?
Yeah, there are going to be a lot more interactive components to this game. So think QR codes, think interactive banners. There's going to be more of an opportunity for consumers to be able to purchase products through Amazon. It's apparently not going to totally disrupt the viewing experience, but it's certainly a step forward when we think about Amazon's role in live sports and how the NFL really is embracing all these alternatives to traditional television. And I'd say by and large, this Black Friday game, I mean, Amazon paid $100 million reportedly for the streaming exclusive rights to this game. It's interesting because it's not just for Prime members. If you're a non-Prime member, you can tune into this as well. And that's been very attractive for ad buyers. When you think about the types of companies that want to be on this program, Amazon is charging double what they normally charge for advertisers for the Thursday night football game, which they currently have the rights to. But if you think about big tech as a whole, they've just been gobbling up all of these pricey sports contracts, not just Amazon, but also Alphabet's YouTube. We've seen Apple get more involved in sports, and this is coming as linear television has really struggled. We've seen advertising for linear revenue decline pretty significantly. We've seen cord cutting trends escalate. These legacy media companies are also dealing with really steep streaming losses, so they don't necessarily have the cash to pay these leagues the amount that the tech giants can. So I think overall, this is really a turning point when you think about the future of sports, Amazon's role within sports, and how the NFL is, saying, okay, if linear television can't quite afford us, we're willing to go to those who can. And the game today starts at 3 p.m. That's kickoff. We have a pre-show at 1:30 where Amazon is going to be rolling out some of those interactive ads. Then we also have a post-game concert through Amazon Prime Music. So a lot coming up, and we'll see how those numbers do at the end of the day.
Indeed. Also seeing from Variety that there'll be one big limited time deal per quarter. So it's almost like appointment TV while you're already watching it. So I'm into it. I'm going to check it out. Now, Ali, I know that another thing that you're watching is, of course, the box office. The Thanksgiving holiday used to yield big returns, but that hasn't been the case these last few years. What can we take away from the results so far?
Yeah, Rochelle, we really haven't seen that big box office since before the pandemic in 2019, but it looks like this year could potentially be better than what we've seen in the last few Thanksgivings. In terms of new titles, we have Disney's animated film Wish, along with Apple's Napoleon. Consumers also have the chance to go and see continued showings of the Hunger Games prequel, but Wish is the one that industry watchers have really been focusing in on since it is a family-friendly title. That genre has performed well this year, but Disney has yet to see a big win there, despite historically being the leader in this category. Now, Wish did lead the Thanksgiving Eve box office with 8.3 million in ticket sales, although that was pretty disappointing, considering the goal for this film is to gross between 40 to 50 million by the end of the weekend. The cost to produce this film was also high, with a production budget pegged to around 200 million. And with Disney really in the throes of revamping its studio division, another big disappointment here is just going to highlight how much work Disney has ahead of itself. Now, across the entire box office, industry projections are estimated at 190 million. Now, we haven't seen more than 150 million since 2019. So this would be an improvement, but that number would also severely underperform pre-pandemic times. And that just might be the new reality as the industry adjusts to the streaming boom, more titles going direct to consumer. We'll have to see if those box office figures can hold up by the end of this weekend.
We'll certainly be tracking that. Appreciate you as always, our very own Ali Canal, and have a great weekend.
You too.
Thank you. All right, well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. All right, let's take a look at some trending tickers that we're watching. Shares of Nvidia ending the week on a low note. According to Reuters, the chip maker is delaying the launch of its new China-focused AI chip, specifically designed to skirt US restrictions. China sales make up a little over 20% of the company's data center revenue. And Nvidia earlier this week warned the Biden administration's export restrictions would see sales, quote, decline significantly in the impacted regions. And so, Akiko, as we were having that chat with Ray earlier, we talked about the importance of the data centers here. So interesting to see this. We knew that companies were going to try and find a workaround, but Nvidia was saying this workaround should have still fallen under the purview, still not have really been flagged here. But obviously, Nvidia has a lot of room to run, still the front runner in all things when it comes to AI chips. But interesting to see it take a little bit of a hit here.
Yeah, and that last point you made about NVIDIA being so far ahead is partly why they are right in that crosshairs between what's happening between US and China, because the focus on those export controls that NVIDIA is trying to find the workaround is about advanced chips, not sort of the low-performing chips that we see more on a mass scale. And NVIDIA, being that leader, has been caught right in the crosshairs there. It's not just about the chip design, it's about the manufacturing, the equipment that's used for all that. So certainly continuing to be a rough road for a company like NVIDIA, as the US has said, made very clear that their target here in those export controls are about national security, sort of the most advanced chips. That's kind of right where NVIDIA competes on. Well, shares of Visa hit an all-time high in today's session. Visa stock has been steadily on the rise since the company's last earnings report, which forecasted a resilient outlook on consumer spending. Rochelle, resilient, yes, but this weekend we're going to get a really good pulse on where the mindset is going into this holiday season. We were talking about this earlier about Americans increasingly turning to their credit cards, right, to be able to spend during the holiday season. Yes, they want to buy up more gifts. Yes, there's an expectation of retail sales going higher, or at least within the holiday shopping season. But a lot of those charges likely to go on their credit cards, given the trend that we've seen leading up to this holiday season.
It's true. And also looking at shares of MasterCard as well, similar story there. And so when you think people are saying, look, we're strapped for cash here, still willing to spend though, and as we mentioned, it's about how they're paying for it. We talked about credit card debt, buy now, pay later, which itself does not show up on your credit report, but once you miss a payment, those delinquencies, they do start showing up. So you have to wonder when some of these things are going to come home to roost. We've been seeing a lot of in these earnings calls, retailers worried about the softer consumer here, still willing to spend, but as we've seen, some trading down, perhaps instead of, going all out and having a big renovation or something, trading down to something smaller, perhaps going in a little bit less, trying to be a bit more discerning here. But it's really hard to marry this with a lot of the concerns people have going into 2024 about how bad they feel about the economy when they're still spending, and we're still seeing credit cards going up as well, that credit card spending.
Yeah, Rochelle,
to wrap
your
up Black
conversation
Friday.
about buy now,
Go
pay
ahead.
later just made me think about where some of these stocks are trading in that space as well. Affirm obviously has seen a big uptick too. That stock up more than 170% this year.
And of course, to wrap up Black Friday, let's also take a look at some of those retail stocks. You're looking at shares of Walmart ending today's trading a bit higher. The company gaining back ground after its weaker full-year forecast sent shares sliding 8% last week. The company echoing similar caution from other retailers worried about consumer demand heading into year-end. Now, other names in retail include Best Buy, Lowe's, Home Depot, and Target, all ending today in the green. Also taking a look at what we're seeing with Amazon shares, especially as workers across several countries walked off the job, striking for higher pay and better working conditions. And you figure when you have the spotlight on a company like Amazon, when it's Black Friday, key shopping season, that this is the time to get the most attention on these issues. But of course, we've been taking a look at what we've been seeing with these Amazon strikes, as we've seen these other unionized movements continue across other industries, as we saw with UAW, as we saw with the healthcare strikes, that really spotlighting this, even the Starbucks strikes that we saw on their Red Cup Day. So we're still continuing to see that, at least for now, not seeing that affecting Amazon's bottom line, but you have to wonder how that's going to start showing up in additional quarters going forward, Akiko.
Yeah, I mean, employees still increasingly feeling empowered, that they still do have leverage. And obviously, we're not talking about just the U.S. market, but when you consider what's been playing out here in the U.S., it is also about the labor market being fairly tight, having a little more leverage for those employers. So interesting to continue to monitor the ripple effects that have been playing out here. And as you see right at the bottom of the screen, we're talking about more than 30 countries now in terms of this protest on working conditions. Well, a year ago, much of the U.S. was convinced 2023 would bring a recession. Instead, the economy's chugged along on a steady path of growth, thanks in part to a resilient consumer and in spite of the Federal Reserve's aggressive rate hike campaign. But as we prepare to enter 2024 with a higher for longer rate environment, could the long-anticipated recession finally come to fruition in the year ahead? And what's the best way to anticipate that market volatility without missing on some of those short-term gains? We're joined by Tim Urbanowitz, Head of Investment Strategy Research at Innovator Capital Management. It's kind of a good conversation to be having here on what is a traditionally a slower trading day. But how are you looking at your portfolio right now with this expectation that regardless of where the Fed moves, those rates where they are right now are going to remain there for at least a majority of 2024?
Yeah, it's a very important question right now, and the market seems to care about one thing and one thing only, and that is what is the direction of interest rates from here. You've seen some good inflation data here recently. It's some data that has reinforced our view that you're going to continue to see the Fed on hold at the current level. But if you look at the reaction from the equity market, I would characterize that as a bit of an overreaction here recently. We have to remember that prices are still too high. If you look at where core prices are relative to where we were in 2019, they're up 20% from those levels. So to sit here today and see the market pricing in multiple cuts starting early next year, we think that is very aggressive and quite frankly, not something that you're going to see until you start to see wages come down at a more meaningful clip. I don't think you can sit here and just become complacent and think that interest rates are going to come down. The costs of the Fed cutting too early are far too great. We saw them make that mistake in 1966. We saw them make it again in 1980. And I can guarantee you that Jay Powell is not going to want to be the guy to make that same mistake in 2024. So it could be a slower clip than most people think, which means higher for longer.
So Tim, for people looking at this, they're listening to what the Fed is saying, that they've not even mentioned those rate cuts in those FOMC minutes, but then the market is racing ahead. You look at where the VIX is, it's looking at pre-pandemic 2020 levels when it comes to the fear index here. So how should people play this? What is the strategy? What should they focus on so that they cut through the noise and have a strategy that works for them for this period?
Yeah, well, the focus has to be on remaining invested in the equity market. We have seen so many retail investors, so many advisors that have sold out and went to cash. That has been a big mistake. If you look at the rally that we've seen here recently, we have been out there pounding the table that the time when the Fed pauses is a very profitable time to be in equities. Yes, there's headwinds, but you have to be invested. And so one of the strategies that I think a lot of advisors have been finding value in here recently is under the umbrella of defined outcome ETFs, which is where we specialized. And the ticker on this one is TJUL. This strategy is designed to provide a 100% buffer against losses on the downside, while simultaneously providing upside exposure on the S&P 500 ETF to the first 16.6% over a 2-year outcome period. So the reason we're seeing such interest in this strategy right now is it really gives you an alternative to cash to still stay invested. Yes, you're helping hedge and protect on the downside, but you're not making that mistake to sell out and go to cash. If you think about what you need to get right to make the cash call, not only do you need to know when to get out, but you also have to know when to get back in. And to try to nail both of those is almost impossible.
Tim, I mean, when you talk about that return, you just pointed to less risk, but what is it about that mix and how should investors draw conclusions from that?
Yeah, well, I think you have to view that in the context of where we're at in the cycle and what the expectations are for equities next year. We are of the mindset that we are going to be in a low growth environment, but not necessarily a negative growth environment. And a couple key reasons for that. Number one comes down to what we're seeing from the labor market. Interest rate hikes are clearly having an impact there, but it is taking time. There's still a lot of slack that needs to work its way out. If you look at the quit rate The quit rate is still elevated. That's a leading indicator of what we're going to see over the next 6 months. At the same time, if you look at job openings, we still, to this day, have more job openings than we do unemployed workers. That's going to take time to work its way out. The rate hikes are doing that, but it's going to take time, which might push this recession off another year or so. The other reason, I have a hard time seeing us in a negative growth environment when you have the Treasury that is out there running a $1.5 to $2 trillion deficit. So we think in this context, you look at those defined outcome strategies like TJUL, what is the catalyst to drive markets beyond that total return? We struggle to see it. Another idea that we're talking a lot about as we head into 2024, again, under that category of defined outcome ETFs, is ticker XBJA. This strategy provides 2x exposure on the upside to the S&P 500 to a cap of about 18%, while also providing a buffer against losses of 9% on the downside. So you have that acceleration, that 2x on the way up to really help hedge those low returns, deliver positive and significant equity returns, but also that buffer on the downside. If we're wrong and conditions do deteriorate quicker than we anticipate, you have that recessionary hedge with the buffer. So it's those kind of strategies we think are going to become really important in the new year.
Certainly important, especially for the risk averse. It's been a very choppy year so far. Appreciate you joining us this afternoon, Tim Urbanowitz, Head of Investment Strategy Research at Innovator Capital Management. Have a great weekend. Thank you.
You too.
All right, coming up, we're talking mental health for teens with the CEO of Talkspace. Stay tuned.
Well, teenagers in New York City now have access to free virtual mental health support. Talkspace, an online therapy company, launching free virtual mental health services this month to more than 400,000 adolescents and teens. The program, dubbed Teen Space, is the largest teen mental health initiative in the country. For more on this, let's bring in John Cohen. He's Talkspace CEO, as well as our very own Anjali Kamlani, joining in on the conversation here. John, it's good to talk to you today. Talk to me about how this all came about. Why specifically focus on New York City?
Well, I think if you look back probably since the beginning when Mayor Adams took office, he made it clear that mental health was a huge issue that he needed to address in the city. So there's been a whole slew of mental health initiatives that he's launched. One of them would be was going to be how they address the issues for teens, because as you know, there's a huge mental health crisis in teens around the nation.
John, Anjali here. I wonder if you could tell us about how this relationship came to be. I know that for years, the teen mental health space has been one that many companies have tried to get into, and all have tried routes by maybe linking up with school districts and trying to get funding there, or just relying on investors. And so this route using city funds through the health department seems to be a new avenue, and one that could get you further along in establishing a program. How did that conversation start?
Well, the conversation started because the mayor, as I said, expressed significant interest. He expressed interest through the commissioner of health through New York City, and then through the commissioner of mental health, deputy commissioner of mental health, and they began to look out to see, what they could do to provide something really different for New York City than had been provided for most other cities around the country. I just want to, reiterate, so is 22% of teenagers have seriously considered suicide, and 10% have actually attempted to commit death through suicide. 57% of teen girls find their life to be sad or just incredibly hopeless. In the last year, 25% of teenage girls have visited the emergency room for a increasing mental health crisis. So if you put that together with what's going on in the social media addiction that you've heard from the Surgeon General, the crisis is very, very real. So these conversations began to happen. We talked about what Talkspace could offer, which is very different than most other virtual mental health companies, and that's how it actually began.
I wonder, does this take you on the path? I know you've projected breaking even by 2024. How does this affect that projection?
Well, we have so Talkspace has been around for 13 years. It's a big brand. As you know, the market for telehealth mental health is just enormous, given the interest and the need from employers and universities and colleges and of course schools and teenagers. So we made a decision that we have two big lines of business at Talkspace. One is you get therapy through your health insurer. We have 112 million covered lives. We're the largest telehealth mental health provider in the country that is in network. So in other words, if you come to Talkspace and need therapy, chances are you're covered. So it doesn't cost you anything, or you have a small out-of-pocket copay. The other part of the business is direct enterprise, which is what the schools fall into. So the schools, colleges, universities, large and small employers will frequently put Talkspace on as an added benefit so that people can have better and quicker access to mental health support. As far as Talkspace is, yes, you've seen our guidance. We have guided that we will be break even by the end of Q1 of next year, which is 4 months away. And in addition, we'll have $120 million or more of cash on hand. So we have very little, if any, cash burn at this point. So we've put ourselves in a very, very good position to both have the cash that we'll need to do other investments, M&A, et cetera, and at the same time to continue to significantly grow the business on the two verticals that I just talked about.
I will appreciate you taking the time to join us this morning. Yahoo Finance reporter Anjali Khemlani and Dr. John Cohen, Talkspace CEO. Thank you so much for this important conversation.
Thank you.
You're very welcome. Well, that does it for now. I'm Rochelle Akufo with Akiko Fujita. Thanks for watching and have a wonderful weekend.